Welcome you all to the day 2 session. Hope my voice is loud and clear. Can one of you confirm?
Yes, sir.
Yes, sir, your voice.
Okay, thank you. Yes, hope the screen is visible on topic 3, general anti-avoidance and rules. Hope you remember the pointers and rules. I think any doubts from day 1 on the topics that we have covered already in the direct tax and international taxation? Any clarifications or any kind of questions that you have? We'll spend some 5 to 10 minutes now before we proceed to the next topic. Can you quickly confirm about the same? Okay. What about others? I will be sharing that probably tomorrow or so. I'll look for it and share it with you.
Okay, sir.
Can we proceed to general anti-avoidance rules if there's no other kind of concerns or challenges?
Yes, sir.
Yes. So the first thing that we want to understand is what is general anti-avoidance rules. So when I say general anti-avoidance rules, it is with respect to evasion or kind of concern that the tax authority has in terms of where they are looking at the concept of evading or planning or structuring in such a way that the aspects of tax collection is going for a toss. Okay, so there are transactions which are getting structured in such a way that they're not required to pay any tax. So that is called as anti-avoidance rules. Now we have something called as avoiding a person framing a transaction in such a way to avoid the tax is called as giving a rule to mitigate such kind of situations is called as general anti-avoidance rules. Now, let us assume there are certain impermissible avoidance agreements. Okay, we'll understand what is impermissible avoidance agreements. But when we come into impermissible avoidance agreement, we need to understand what are the types of arrangements that are not permissible. When I say it is not permissible, it means to say that it is not available or it is not possible for a person to take such kind of transactions in order to have the tax liability mitigated or reduced. The intention of such structuring is only to reduce the tax liability. So if the intention of framing an arrangement is to reduce the tax liability, then that kind of arrangements is known as impermissible avoidance arrangements. When I say impermissible avoidance arrangements, that means to say it is not permitted under law. So giving a rule to mitigate or to focus on this kind of arrangements or rules which are focusing these kind of arrangements is our general anti-avoidance rules. So this is generic in nature. We have something called as specific anti-avoidance rules also. So GAR is known as general anti-avoidance rules. SAR is known as specific anti-avoidance rules. Slowly, when we get into it, each of the concepts, we'll try to understand. So what is the GAR and its applicability? What is general anti-avoidance rules or GAR and its applicability? Let us try to understand first the key definition of general anti-avoidance rule. Now, general anti-avoidance rule refers to any transaction or business arrangement that is entered into with the objective of avoiding tax. That is what I was trying to tell. If the transaction or if there is an arrangement which is devised in such a manner to mitigate the tax or in order to reduce the tax liability is called as the transaction which is not available. Okay, these rules monitor or overview or target such transactions which are devised in order to avoid the tax. The objective is to check aggressive tax planning. So what we call in the regular framework, what is permitted by the law or within the framework of the law is known as tax planning. Now, if we go one step beyond to make an aggressive planning, aggressive means very futile kind of arrangement where we are going over and above the intention of the law. Now, the intention of the law is to give benefit within the framework. Okay. Now, you are interpreting in such a way that you are going beyond the framework in order to ensure that you are getting aggressive tax planning benefit, which is not permissible. And these rules focus on such kind of arrangements. Okay. So let us try to understand further. It may be noted that GAR provisions would be applicable to all taxpayers. Okay. There is no differentiation to state that it is only applicable to private companies or it is only applicable to listed companies or it is applicable only to partnership firms. You need to have this point noted and keep in your mind that it is applicable only to it is applicable to all the assessees, not a specific person. Okay, it is applicable to all the taxpayers, irrespective of their residential status or legal status. That means even a non-resident is coming under the purview of applicability to whom it might get triggered. The moment I say it gets triggered, it will become liable for the person's taxability.
You are audible, sir.
Is my voice not clear?
Now it is clear, sir.
Is everybody facing the same issue? Can others confirm?
No, sir.
If you want to rejoin or exit from the meeting and then rejoin, you can try once or you can check your internet connection I think you should be able
All
to hear
right.
me.
All right.
So we were discussing about the applicability. The applicability is irrespective of legal status or residential status. It is applicable to corporate entity and non-corporate entity, everybody. The provisions apply to all kinds of transactions and arrangements, irrespective of nature. That is, business transaction or a non-business transaction. It is applicable to all kinds of transactions. If the tax benefit, if there is a tax benefit because of such arrangement or transaction, then if that accrues to the taxpayer and he fails to establish that the main purpose of entering into transaction is or arrangement was not to obtain the tax benefit. Now it is the ownership or it is the responsibility of proving that it was not entered or it was not transacted only to get the tax benefit. If he does not prove that, then it becomes that it is entered only to get the tax benefit, and aggressive tax planning and general anti-avoidance rules will get triggered and becomes applicable in that case. So it is on the assessee to prove that it is not entered only to get the tax benefit. For GAR provisions, it is also not relevant whether transaction or arrangements are entered into with group concern or third parties and whether they are domestic or cross-border transaction. So when I say all transactions, it might be between any particular party or it might be applicable to all kinds of people, that it might be residential or non-resident or a corporate assessee or non-corporate assessee, or it is not even relevant whether it is transacted between the same group company, holding company, subsidiary company, or associate companies, or it is third parties. It is not relevant with whom it has been entered. If the intent is to do an aggressive tax planning to avoid the tax, then these rules will focus on such kind of transaction, whether they are domestic or cross-border transactions. Hope you are able to understand the intent or the meaning of the GAR. So, for calculation of threshold, we say 3 crores as per the rules. That means the threshold of INR 30 million, that is 3 crores as per the normal Indian rupees. Only the tax benefit enjoyed in the Indian jurisdiction due to the arrangement or part of the arrangement is to be considered. Now, such benefit is assessment year specific. That means every year it should be more than 3 crore. GAR is with respect to an arrangement or part of that arrangement, and limit of 30 million or 3 crore cannot be read in respect of a single taxpayer only. That means it cannot be limited to a single taxpayer. Now, when I say it should be within the assessment year specific, in a particular year, the transaction should have derived the benefit of tax more than 3 crore. Because of doing a transaction in a particular way, I've got the benefit of 3 crores of tax. Then the general anti-avoidance rules can get triggered and it can be tested whether the transaction was entered only with the intention of reducing the tax. If it was only with the intention to reduce the tax, then he need to pay the tax according to these rules, and he need to these rules get triggered. If the assessee proves that it is not only with the intent of tax benefit, I have done it for better business expansion, and if he can prove that it was not only for tax benefit, then then the rules does not get triggered, and there is no need for him to get attracted with any of the penal provisions of the GAR. Now, this is called general anti-avoidance rules. Let us try to understand next concept. What is the implication of GAR implementation? When the GAR gets implemented, that means this was introduced in 2015 or 2016. Until then, it was not applicable. Only from 2016 onwards, it becomes applicable. Once GAR gets triggered, what happens? The implication of GAR is that the income tax department will have powers to deny tax benefit if a transaction was carried out exclusively for the purpose of avoiding the tax. Now, if they ensure that the assessee is not able to prove that the transaction was not entered only to get the tax benefit, then income tax authorities will decide, or income tax authorities will ensure that it is entered only with the tax benefit. Then they will be able to deny the tax benefit. So whatever the tax benefit that they are getting, they will be denied with that, and they can levy the collect back the taxes. They have such powers. For example, we have an example where if an entity is set up in Mauritius with the sole intention of claiming exemption from capital gain tax, the tax authorities have the right to deny the claim for exemption provided under India-Mauritius tax treaty. Now, as per treaty, it says capital gains are not subjected to tax if the capital gains is arising in Mauritius. Then, if this kind of setup is done only for the benefit of getting the tax benefit, then they will be able to subject to deny the benefit and they can recover the taxes applicable on such transaction. So this is the implication on implementation of GAR. That means once GAR gets triggered, this can be the implementation. This can be the possibility. Now we say, like I said, impermissible avoidance agreement, IAAA. Okay, IAA, impermissible avoidance arrangement or agreement. Now, this is not permissible. Where can an arrangement be declared as an impermissible avoidance arrangement? Now, for GAR to be triggered, first the arrangement or the entire transaction should be classified as IAA. What is IAA? Impermissible avoidance arrangement. Now, what is impermissible? When can it be considered as impermissible avoidance arrangement? The income tax commissioner will be empowered to declare an arrangement as an impermissible avoidance arrangement if A, B, C, D options are getting satisfied. What are those 4 conditions? Creates right or obligation which are not ordinarily created between persons dealing at arm's length. Now, if it gets created, if there is any right that is getting created with which obligation which are not ordinarily created between persons dealing at arm's length. So if there is any specific right that they get or any benefit that they get, if at all, if it was done in an ordinary course, it would not have happened. But they have devised a transaction in such a way that they're getting this device benefit to a particular person, which ordinarily in regular course would not have happened. Results directly or indirectly in the misuse or abuse of the provisions of this act. Results directly or indirectly in the misuse or abuse of the provisions of the of this act. Lacks commercial substance or is deemed to lack commercial substance under section 97 in whole or in part. So this transaction is completely done with the intention of the benefit without any commercial intent. That means the business objective at all is not there, or the commercial intent is not there. If commercial substance is not at all there, then it will become that it is impermissible avoidance arrangement. The last option is entered into or carried out by means or in a manner which are not ordinarily employed for bona fide purpose. Now that means this will not happen in this manner. Only for the purpose of tax benefit they have entered in this kind of situation. So it is not a bona fide transaction. Now 4 conditions. What are those 4 conditions? That if this is not entered in an ordinary course of business, benefit that is derived, if at all, if it is not done in an ordinary course, then you have directly or indirectly misusing or abusing the tax provisions. Then you have the commercial substance not being visible. And the last one, you have bona fide purpose is not there in the transaction. If these 4 conditions gets attracted, then one can say this transaction is an impermissible avoidance arrangement, and then we can trigger the general anti-avoidance rules. Once general anti-avoidance rules are triggered, it becomes that the power of denying the tax benefit is available with the tax authorities. This is so far reaching in nature that almost each and every transaction which results in saving tax could be regarded as an IAAA. That means any transaction, if it is resulting in a tax benefit, it can be termed as IAA. This means that GAR enables tax authorities to declare any arrangement entered into by a taxpayer as an IAA. If it is to be declared, then the tax authorities can disregard, combine, or recharacterize any step of such arrangement or the entire arrangement disregard any accommodating party involved in such arrangement. Now, treat the transaction as if it had not been entered into or carried out, relocate any income or expenditure, look through any arrangement by disregarding any corporate structure, recharacterize debt as equity or vice versa, and so on. This is the ultimate power that the tax authorities have. If they want to relook or go through the transaction again and redevise or recharacterize any component or any party or any kind of instrument, they can do it. And that is the power that the tax authorities is having in terms of characterizing this as impermissible avoidance arrangement. In effect, for tax purposes, any transaction can be treated in a manner different from the manner in which it is carried out if it is regarded as an IAAA. Okay, so this is called as, in effect, for tax purpose, any transaction can be treated in a manner different from the manner in which it is carried out if it is regarded as an IAA. That means any transaction they can trigger if there is a tax benefit that they are able to see, and if there is no commercial substance, if the tax provisions are misused or abused, and if this kind of benefit would not have appeared in an ordinary course of business, and if the bona fide intention is not there, if these four conditions satisfied, they have the complete right to disregard the benefit of tax benefit and regard this as an impermissible avoidance arrangement. Are we clear till here?
Yes, sir.
Yes, sir.
Let's move to next concept. Difference between tax avoidance and tax evasion. Yesterday we have seen this. Quickly,
Yes, sir.
I'll give you the framework in terms of general anti-avoidance rules. The tax evasion and tax avoidance are two different things. While avoidance is a legal management to avoid tax, evasion is illegal means to reduce the tax liabilities. That means avoidance interpretation, I understand it as ABC, and tax authority I understand it as PQR. So it is an interpretation difference. So that is called tax avoidance. Now, if it is in terms of I know it is ABC, but I'm not following it as ABC, there is no PQR possibility. Okay, it is only ABC, but I'm not following ABC, then it becomes tax evasion. Falsification of books, suppression of income, overstatement of deductions, etc., which all of this we have seen yesterday. Tax planning, as opposed to tax evasion, which is illegal, is an accepted practice whereby the taxpayers use provisions of the law or loopholes to minimize his tax liability. So this is with respect to tax planning, as opposed to tax evasion, which is illegal, is an accepted practice. Tax planning is an accepted practice whereby the taxpayer uses the provision or the laws to minimize his tax liability. So we understand tax planning in such a way. Some countries, in addition to general anti-avoidance rules, have specific anti-avoidance rules to plug particular loopholes in the law or prevent some types of transactions that result in loss to revenue. So that is called a specific anti-avoidance rule. Now, if you see, we have the limits. Why are the limits given? Now, I said yesterday, I was always telling, if there is a public provident fund or tuition fees or life insurance, then I'm always telling that 1,50,000, 1,50,000, 1,50,000. That means the limit is given. So they don't want somebody to invest 1 crore in life insurance and claim entire thing as tax exemption. So they've limited it to 1,50,000 and they've plugged it with a specific rule. What is the specific rule? That any person can contribute maximum up to 1,50,000. So these kind of lot of provisions are there.
Standard deduction. Okay.
Yeah, standard deduction. Many things are there which are known as specific anti-avoidance rule. The general anti-avoidance rule is very broad in nature. It can attract any transaction into any kind of situation. But in case of specific anti-avoidance rule, it is specific to that particular provision and law. Now, what is plug particular loopholes in the law or prevent some type of transactions that result in loss to revenue. Now, GAR has been a part of tax code of Canada since 1988, Australia since 1981, South Africa from 2006, China from 2008. Australia and China also have SAR in place to check abuse of tax treaties and transfer pricing. Now, these countries, it has from 1988 to 2008, and in India, it became part of the law only in 2016.
Do we have any monetary limitation in SAR cases? Likewise, we have in GAR 3 crores, right?
SAR is a specific thing. If you go to section 80C, it says 1,50,000. Standard deduction 50C. Definitely, in every specific rule, there is a limit. If you go to house property loan, interest on housing loan, 2 lakhs. The 2 lakhs is a specific limit. So each provision has a specific limit. There is no overall limit, but each provision has a limit. If you go to ATD, medical insurance is 25,000. ATU, incapacity of physical disability of a person, 75,000. So every different rule has a different limit.
All right.
What is round trip financing? This is one of the questions frequently asked, or a kind of question, a terminology which is coming out from the GAR chapter. One has to know that Section 97(2) of the Income Tax Act defines round trip financing to include any arrangement in which, through a series of transactions, okay, funds are getting routed from one country to third country, from third country again it is coming back to India. Okay, say for example, China doesn't want to invest in India. Now China will invest in Singapore, and Singapore in turn invests in India. Instead of directly investing in India, China invests in Singapore and Singapore invests in India. So this becomes round trip financing. Through a series of transactions, funds are transferred among the parties through the arrangement, and such transactions do not have any substantial commercial purpose other than obtaining the tax benefit. Say for example, directly China can invest in India. Now China has a restriction that they cannot invest in India, or China thinks that if it is directly investing in India, then capital gain transactions will come into picture. Now, India and Mauritius has a tax treaty which says capital gains are not taxable. Now, China will go to Mauritius, invest in Mauritius, and then indirectly invest from Mauritius to India. When there is a gain, when they sell, the Mauritius entity will sell the shares in India, then there is no capital gain taxation. Then they will take back this money back to the Indian countries. Yes, shell countries also can get involved in such transactions. That is why most of the things are coming in par now. There is something called base erosion and profit sharing plans or rules. Action plans are being implemented to avoid and take care of these kind of transactions. Cherry picking, treaty shopping, tax events, all of this. Now they are aligning that no country can have tax-free situation. They should at least minimum levy of tax should happen, irrespective of whether it is their country has domestic law, has a tax rate or not. Now they are equalizing everything to bring it at par. Otherwise, people will select. If they select, if India is 30% and USA is 10%, they'll go to USA. They don't come to India. And if it is Mauritius 0%, then they'll go to Mauritius. If Netherlands is 0%, they'll go to Netherlands. So they want to equalize all these things. Base erosion, profit sharing action plans are already in force, and they are taking care of these kinds of situations. So round trip financing is nothing but series of transactions routed through different different entities or countries to avoid the tax liability in order to reduce the tax amount, and there is no commercial intent between this transaction, then it will become a round trip financing. Difference between general anti-avoidance rules and specific anti-avoidance rules. Now, first let us see what is specific anti-avoidance rules. Now, these are specific and help reduce time and costs involved in tax litigation. So they have reduced. They've told housing loan interest means 2 lakhs. ATC deduction means they have told very clearly that it is 1,50,000. Insurance deduction of medical insurance is 25,000. So it is very clear. There is no confusion. And so this helps in compliance properly and reduce the litigation. So nobody can tell, I thought it was 1 lakh. The other person thought it was 10 lakhs. I thought it is only 4,000. So there is no confusion. These provide certainty to any taxpayer while formalizing specific arrangements. These do not provide any discretion to the tax authorities. That means now there is no powers that are there to discreetly do things in their own manner. They also have the guidelines to state that if it is up to 1,50,000, they cannot deny. They will have to provide it. Only if it is more than 1,50,000, they cannot provide. They can deny. But up to 1,50,000, if it is within the limit, they'll have to oblige and they'll have to ensure that it is relief is given. So they don't have any discretionary powers to do in their own whims and fancies. There is always a possibility that the taxpayer find loopholes and circumvent this limited application specific provisions. That is when GAR will come into picture. Now, when there is no specific rule or limit guiding the transaction, then he can circumvent and find out what are the loopholes, and that is when it becomes the general anti-avoidance rule gets involved. Now, what is general anti-avoidance rules? These involves necessarily granting the discretion to the tax authorities to invalidate the arrangements as impermissible tax avoidance. Now, granting the discretion, that means the powers are there with the income tax authorities to disregard the tax benefit and invalidate the arrangement as impermissible avoidance arrangement. They have a far broader application and hence interpreted in more extensive manner. GAR has the potential to counter more effectively and outsmart the taxpayers. If taxpayer is smart, then income tax authorities can outsmart through GAR and their out-of-the-box thinking and their approach in devising new means of tax avoidance. So whatever the smartness the taxpayer shows, they can outsmart that kind of smartness, and they can invoke the provisions and deny the tax benefit by virtue of powers that are envisaged in GAR under the provisions of the law. So this is the differences between GAR and SAR. Moving on to next concept, exclusions from GAR. Is there anything that gets excluded from GAR is something that we need to see here. Okay, when we see what does it get excluded from the GAR, Rule 10U of the income tax rules provides for certain exclusions. What are these exclusions? Exclusion from the provisions of GAR, which are discussed below. Monetary threshold. Anything less than 3 crores is excluded. Simple. As discussed above, there is a monetary threshold limit of INR 3 crores or 30 million for the applicability of GAR. The threshold has to be seen with respect to each assessment year. That means if one of the assessment year I have 2 crore 90 lakhs of tax benefit, and in another year I have 1 crore 50 lakhs of tax benefit, then in both the years GAR will not get attracted because each assessment year it is less than 3 crore. Also, the threshold is not taxpayer specific and it has to be determined with regard to all the parties to the arrangements. Now, this is tricky. Now, if the tax benefit that I and you are entered into a transaction and you are getting 1 crore tax benefit and I am getting 2 crore 50 lakhs as tax benefit, now both of us are getting 3.5 crores. Now, I cannot tell it is less than 3 crores for me and less than 3 crores for you. Now, both put together, the overall tax benefit is 3.5 crores. It is over and above the 3 crores. It is not taxpayer specific. It is the arrangement specific. In an arrangement, if there are 10 parties and if each party is getting 25 lakhs of tax benefit, okay, then 2.5 crores is the overall benefit derived from the arrangement. Then overall, all the 10 parties, it is less than 3 crores. It does not attract. Let us assume overall 10 parties, each of them is getting 35 lakhs of tax benefit. Each of them getting 35 lakhs means the overall benefit from all the arrangement, from the entire arrangement for 10 parties is 3.5 crores. Now, 3.5 crores is over and above the 3 crore. Then this will get triggered with the general anti-avoidance rules. Then comes exemption to foreign institutional investors and foreign portfolio investors. So these rules does not attract to FIIs and FTIs. These rules provide that the provisions of GAR are not applicable to an FII. Exclusion from P notes, investments in FIIs. The provisions of GAR shall not apply to a person who is a non-resident in relation to investment made by him by way of offshore derivative instrument or otherwise, directly or indirectly in an FII. Basically, they're focusing to give the relief to foreign investors in the form of foreign institutional investors. The term offshore derivative instruments mainly indicates investments made by way of P notes. Further, there is no threshold in respect of this investment. Even the minimis stakes are grandfathered by this clause. That means any kind of, there is no threshold in respect of this investment, any kind of stakes are grandfathered by this clause. That means even if it is more than 3 crores, it is grandfathered and any kind of situation is taken care in this transaction as an exemption. So finally, exclusions are if it is less than 3 crore, it is excluded. Foreign institutional investors are excluded. Directly or indirectly, P notes and investments through offshore derivative instruments are excluded from the applicability of GAR. Are we clear till here? Any doubts?
No, sir.
Okay. Now again, we have the same kind of question. SAR and GAR are being asked in a different way. Discuss in brief some distinguishing features of general anti-avoidance rules and specific anti-avoidance rules. Distinguishing features are as under. The distinguishing features of general anti-avoidance rules are these involve necessary granting the discretion to the tax authorities to invalidate the arrangements as impermissible tax avoidance. So they have the powers, they have the complete authority and discretionary power to do so. They have a far broader application and hence interpreted in a more extensive manner. That means they can redevise or recharacterize or re-see into transaction in any manner that is required in order to protect the interests of the judicial authorities or the tax authorities. GAR has the potential to counter more effectively and outsmart the taxpayer in their out-of-the-box thinking and their approach in devising new means of tax avoidance. So this is the distinguishing features of GAR, which we have already seen. I am just repeating it again. Coming to SAR, again, it is same that it helped to reduce the tax litigations and cost involved, and they have they provide certainty to any taxpayer while formalizing specific arrangements. Then I can plan. I know that PPF can be invested only up to 1,50,000. I can plan and invest 1,50,000. So it gives me clarity to do the investment in a specific and limited manner. These do not provide any discretion to the tax authorities, and there is always a possibility that the taxpayer may find loopholes and circumvent the limited application of specific provisions. Same we saw, same pointers, difference between GAR and SAR, but it is asked in a different way. Are we clear till here?
Sir, can you give me one example where I can compare both SAR and GAR using similar provision?
No, when SAR is applicable, GAR will not be applicable.
There is some standard deduction and something for SAR applicable. He's using some other transaction. That's why GAR is applicable for the same type of transaction. Can you give me?
Not for a same type of a transaction. Now, say for example, you have specific anti-avoidance rules for all small transactions, which is only to prevent the domestic transactions or local or small transactions. General anti-avoidance rules is to focus the bigger transactions and bigger tax planning. So usually when a GAR is applicable, SAR cannot be applicable because SAR focuses on small aspects and GAR focuses on broader aspects and bigger aspects.
Okay.
So there is no particular transaction where both GAR and SAR can come into picture, basically.
Sir, I want to add something here.
Yes, go ahead.
GAR provisions are applicable to impermissible avoidance arrangements. We can say like that.
Correct.
Yeah.
GAR can be triggered only when the transaction is regarded as impermissible avoidance.
Impermissible. Others are classified under specific.
Others, if it is getting covered under specific rule, then it gets covered under specific anti-avoidance rules.
Okay, sir.
Not that if it is not specific, it can come directly under GAR. GAR, it can come to the testing situation of a GAR, but not that all transactions will pass the rules or the conditions mentioned under GAR. The 4 conditions should get satisfied, then only it can be regarded or GAR can be triggered. When there is no specific rule, then it can come under the radar of GAR. That does not mean always it gets triggered by GAR.
Okay, it views as a general.
It is general anti-avoidance rules, but it has to pass the 4 test. Only when it passes the 4 test, then it will be becoming GAR.
Okay, sir.
Sir, in the material under FAQs, one of the questions was, will GAR be invoked if SAR applies? And they have given that it can coexist.
Correct. It can coexist only when if it is very bigger transactions. I don't see any kind of such transaction. If SAR is already applicable and GAR is where there is a very big transaction, I don't see any kind of such kind of situation, but it can happen, but it has to pass the test again.
Okay, sir. So if we are asked...
FAQ given by CBDT, you can tell it coexist. You can tell it as coexist. That does not mean, see, the practical understanding is that usually SAR focuses on the smaller transactions. GAR focuses on bigger transactions. But if there's some transaction which comes in both SAR and GAR, then it can attract both.
Okay, sir.
Can we proceed to next?
Yes, sir.
Okay. We'll take a small 2-minute break and then come back and take it back. So 10:45 or 10:45, 5 minutes, we'll take a small break and then come back and start with transfer pricing.
All right, sir.
Okay, let us continue. So we are proceeding to the next topic, transfer pricing. After this, we'll be left with another topic of place of effective management. So we'll proceed these two and then proceed to the GST and customs.
Okay, sir.
Okay. So what do you understand from transfer pricing? Let me give you a broad overview of transfer pricing. What are the concepts that are covered in transfer pricing? You need to be aware of something called as two important terminologies: associated enterprise and arm's length price, and determination of arm's length price, and transfer pricing documentation and advance pricing arrangements or advance pricing agreements, and rollback provisions of advance pricing agreement. These are the 5 to 6 topics that are very important. Associated enterprise definition, arm's length price definition, determination of arm's length price. 5 methods are there. Those 5 methods are important, and then becomes your advanced pricing arrangements or agreements, and rollback provisions of advanced pricing agreements. And also you have called something called as transfer pricing documentation under section 92D. That is critical and important, which needs to be remembered. Let us try to understand each of them one by one. Discuss the meaning of the term associated enterprise as defined under section 92A1. So this is very important because this is the term that I said, associated enterprise, which they will ask, which is defined under section 92A subsection 1. This has around 13 situations. We'll try to understand each of them. Transfer pricing provision applies only to transaction between associated enterprises. So since it applies only to transactions between associated enterprises, it is very critical for us to understand what is associated enterprise. As per section 92 capital A subsection 1, an associated enterprise in relation to another enterprise means an enterprise which participates directly or indirectly or through one or more intermediaries in the management or control or capital of the other enterprise. That means one enterprise is participating directly or indirectly, that is directly in another enterprise or indirectly through another enterprise or indirectly to another enterprise in the management. That means this enterprise is directly managing this enterprise, okay, or it is indirectly managing this enterprise or controlling this enterprise through capital or the management or the control of the other enterprise. That means either it can be management, control, or capital. Either I have a capital here invested directly myself or indirectly from different entity, or I am controlling this entity directly, or I am controlling this entity indirectly, or I am managing this entity directly or indirectly through another entity. Then that is called as I have a transaction in this enterprise, and this enterprise is called associated enterprise. This two entities will be considered as associated enterprise. An enterprise in respect of which one or more person who participate directly or indirectly or through one or more intermediaries in its management or control or capital, or the same person who participates directly or indirectly or through one or more intermediaries in the management and control or capital of the other enterprise. That means now so clause A talks about to enterprise directly or indirectly to another enterprise. Clause B talks about an individual managing these two enterprises. These two enterprises do not have any connection, okay? But I am controlling this entity and also controlling this entity. When the same person, that is me, controlling entity A and entity B, these two entities are called as associated enterprises. Now, these two entities do not have any connection. This entity does not manage the other entity, or the other entity does not manage this entity. Okay, or both these entities do not have any management, control, or capital. But me has control on these two entities, or management of these two entities, or ownership of capital of these two entities. Since the same person is managing or controlling directly or indirectly these two entities, then these two entities are called as the associated
enterprise.
Is that clear? Understood the definition of associated enterprise? Now,
yes, sir.
Going further subclause 2, what we discussed was 92 capital A subsection 1 clause 1. Okay, now we are discussing subclause 2. Further, subclause 2 of section 92A subsection 1 states the purpose of section 92A clause 1. Two enterprises shall be deemed to be. Now, this is called deeming fiction. Okay. Now, what we discussed was a direct application. That means it is an associated enterprise. That is clause 1. Clause 2 talks about deeming fiction, irrespective of whether the transaction management control or capital is there or not. If it is falling in these situations, it is deemed associated enterprise. Deemed to be associated enterprise if at any time during the previous year, any of the conditions prescribed under this subclause are satisfied. Section 92 capital A subsection 2 enlists or provides 13 situations in which two enterprise shall be deemed to be associated enterprise if the prescribed conditions are satisfied. That means 92A1 says when it is associated enterprise, when one entity directly manage or indirectly manage or indirectly controls or indirectly controls or directly holds capital or indirectly holds capital as one situation. The second situation is same person managing the two entities directly or indirectly through management, control or capital. That is called associated enterprise. Then these two entities will be called as associated enterprise. Now, clause 2 or subclause 2 talks about deeming fiction. There are 13 situations, irrespective of clause 1, whether the criteria of clause 1 is met or not. The subclause 2 states that if it comes under these 13 situations, those two entities is always called as associated enterprise, irrespective of the fact whether it is satisfying clause 1 or not. Subclause 2 is a deeming fiction. Clause 1 is a direct provision which needs to be tested for. Now let us. So this is the definition of associated enterprise under section 92A, subsection 1, clause 1 and clause 2. Then comes discuss the meaning of the term deemed associated enterprise. Now you should not get confused between associated enterprise and deemed associated enterprise. You need to be very clear that associated enterprise give two conditions. Okay. And also gives what is deemed associated enterprise under clause 2. Now, clause 2 is deemed associated enterprise. Associated enterprise is 92A clause 1. Okay, 92A clause 1. 92A clause 2 talks about deemed associated enterprise. Deemed, the two enterprises or two entities shall be deemed to be associated enterprise if at any time during the previous year any of the conditions prescribed below are satisfied. Section 92A subsection 2 enlists 13 situations in which two enterprises shall be deemed to be associated enterprise as follows. Now, as and when we discuss, in your own words, start writing down all the 13 situations. Okay, so these 5 boxes will help you to cover all the 13 points. Okay, in each of them you might have 1 or 2 points. Now let us try to understand each of them quickly. Any one of you has already read this?
Yes, sir.
Are you aware of all the 13 situations or this concept?
Yeah. Yes, sir.
What about others quickly? So that I need not spend more time or I need to understand what is the level of comfort here so that we get time for other things.
So I already read once, so it was easy.
It's easy actually. Yeah.
Okay. So quickly we'll run through and we'll leave it there. Let us not spend much time in detailing understanding in examples or kind of situations.
Yes, sir.
Okay. Now, first thing talks about 26% voting power, directly or indirectly. The second one talks about
90% of room.
First one talks about enterprise. Second one talks about person holding directly or indirectly. Third one talks about any loan advance which is more than 50%. And fourth one talks about 10% of the borrowings are more than 10% of the borrowings in one enterprise to the other enterprise. That means if my total borrowings is 100 crores, and if I borrowed 15 crores from one entity, okay, then more than 10% of my borrowings is borrowed in the other entity. So that's that entity and myself will be considered as the associated enterprise. First one, enterprise, more than 26% holding directly or indirectly. Second one, any person directly or indirectly holding more than 26%. Third one, more than 50% is my the loan advance to the total assets. Then fourth one, the borrowings is more than 10% of my total borrowings. Then in these four situations, two entities will be considered as associated enterprise. The next category is about the board of directors. More than half of the board of directors or members of the governing body, or one or more executive directors or executive members of the governing body of one enterprise are appointed by the other enterprise. That means one entity appointing the half of the board of the director of the another entity. That means this entity is appointing 5 directors of this entity. Okay. What is the total number of directors of the second entity? Let us assume 8. Out of 8, 5 are appointed by the other entity. So that means more than half of the board of directors of the other entity is appointed by this entity. So these two entities are called as associated enterprises. Or if one of the executive member or executive director is appointed by this entity, then it will be considered as directly associated enterprise. More than half of the directors or members of the governing body, or one or more of the executive directors or members of the governing board of each of the two enterprises are appointed by the same person. Same concept, one entity appointing the other entity, or I am appointing more than half of the board of director in this company also and in this company also. Then these two companies will become the associated enterprise. Or I appoint one executive director in this company and one executive director in this company, then these two companies becomes the associated enterprise. Moving on to next situation. The first four are general with terms of 26%, 26%, 50%, and 10% category. 26 is in terms of shareholding, and in case of 50% loans advanced, and in case of 10% it is borrowings. Then comes the board of directors, direct and indirect. One entity appointing the other entity, or same person appointing the other entity. So we finished 4 plus 2, 6. Out of 13, 6 is over. Okay. Next comes in terms of 90% category, where we have the manufacture or processing of goods or articles or business carried out by one enterprise is only dependent on the use of the know-how, patent, copyright, trademarks, license, franchise, or any other business or commercial rights of similar nature, or any data documentation during drawings or specification relating to any patent, invention, model, design, secret formula, or process of which the other enterprise is the owner, or in respect of which the other enterprise has exclusive rights. Let us say now, you all heard of McDonald's thing, McDonald's, KFC, okay? Now,
Yes, sir.
the recipe or the process of preparing the pizza or the burger is owned, the patent or the copyright or the secret process or formula is owned by that company's owner situated in a different country. Now, the manufacture that you do in India is completely dependent on the process of that other company. So these two companies are called as associated enterprises. Okay, then comes the 90% or more of the raw materials and consumables required for the manufacture or processing of goods or articles carried out by one enterprise are supplied by the other enterprise or by persons specified by the other enterprise, and the prices and other conditions relating to the supply are influenced by such other enterprise. That means now let us assume a Toyota Group. You know Toyota Group has separate companies for manufacturing of each of the component. Engine will be manufactured in one company, and the bearing will be manufactured in one company. The motor will be manufactured in the other company. The outside body of the vehicle will be manufactured in another company. The glass will be manufactured in another company. Now, the assembling company is completely dependent on the raw materials provided from each of the companies. So this assembling can happen only when there is a raw material provided by the other company. And this company cannot purchase raw material from any other company because it is a branded model and everything has to be purchased from the same company. And the prices are influenced by the group company, and it is decided what price this assembling company will purchase from the bearing company, motor company, glass company, tire company, all of that. Okay, so There are around 15 to 20 companies for each of the part, and the final company will purchase all of these raw materials from these 13, 14 or 15, 16 companies and assemble it at large to make it a final output. So then all these entities will become associated enterprises. So then comes the goods or articles manufactured or processed by one enterprise or sold to the other enterprise or to a person specified by the other enterprise. Now, same example, Toyota says that what a bearing is prepared, it gives the instruction that it should be sold only to the assembly company. It does not have any right to sell it in the open market. So then it becomes the goods or articles manufactured or processed by one enterprise are sold to the other enterprise or to a person specified by the other enterprise. That means the bearing company is selling it only to the assembling company. Who is telling this? The group company. The group company is instructing the bearing company to sell it only to the assembly company. That means, or to a person specified by the other enterprise, or to an assembly company is a specified person. Who is specifying it? Other enterprise, that is group company. And the prices and the other conditions relating thereto are influenced by such other enterprise, that is group company or the holding company, Toyota group company. So in all this case, all these companies will become associated enterprise, where one enterprise is controlled by an individual, the other enterprise is also controlled by such individual or his relative or jointly by such individual and relative of such individual. Now this is control in terms of individual. Now one individual controlling one enterprise, then that two enterprises will be called as associated enterprise. Same thing in terms of Hindu undivided family, where a same entity, one enterprise is controlled by HUF and the other enterprise is controlled by member of the HUF or by relative or a member of such HUF, jointly by such member. Both of this is called as the associated enterprise. Indirect way of controlling both the entities. One is directly controlled by me, the other is controlled by my brother. That means both these entities will become a related party. One is controlled by my HUF and the other company is controlled by the member of my HUF. So both those entities will become the associated enterprise. Then comes the last two, where one enterprise is a firm, association of person or a body of individual, the other enterprise holds not less than 10% interest in such firm, association of person or body of individual. That means one partnership firm holding more than 10% interest in the other partnership firm, both of these will be considered as associated enterprise. There exists between the two enterprise any relationship of mutual interest as may be prescribed. So this is the residual category and the envisaging furthermore powers that can be modified or introduced in later stage, stating that any kind of mutual relationship that can be prescribed as may be in the later. So that is known as the envisaging power. So ideally we have 12 defined deemed associated enterprise and 13 enabling deemed associated enterprise. In future, if required, they can prescribe any kind of mutual relationship. Are we clear till here?
Yes, sir. Very much.
Yes, sir.
Explain the following cases whether the entity shall be deemed to be associated enterprise under section 92A clause 2. Clause 2 means deemed associated enterprise of the Income Tax Act. So we have three situations. Let me put across. Run India Limited has 12 directors on its board, out of which 6 directors are appointed by Resale Limited. Now, is this considered as deemed associated enterprise? What is your answer?
It's only 50%. It should be more than 50%.
Okay. Any other views?
It should be more than 50%.
Yeah, it should be 7, minimum 7. Otherwise, it will not be considered as deemed associated enterprise. 2 enterprises shall be deemed to be associated enterprise if more than half of the directors or the members of the board or one of the enterprise are appointed by the other enterprise. In the given case, Run has appointed only half, that is 6 out of 12 of the directors on the board of Run Limited. Thus, both are not associated enterprise. So, you should be very clear. Most of the time, we'll get confused and write that as associated enterprise.
Yes, sir.
Kane UK Limited possesses 25% of the voting power in Bain India Private Limited. Does that become?
Should be more than 26.
Not an associate enterprise. It should be 26%.
Very good. It should be 26%. It is not an associated enterprise. Two enterprises shall be deemed to be associated enterprise if one enterprise holds directly or indirectly shares carrying not less than 26% of the voting power in the other enterprise. In the given case, the volume of voting power as possessed by Kane Limited in Bain India Private Limited is less than 26%. Thus, they are not associated enterprise. Last situation. Joy India's total borrowings amounted to rupees 1,000 crore, out of which guarantee has been given by Chapel India Limited for a borrowing of rupees 400 crore. That means 40% of the borrowing is guaranteed by Chapel India Limited. Is that associated enterprise?
Yes, sir.
Yes, sir.
It's more than 10%.
More than 10% of the borrowing.
Yes.
The fourth condition. Very good. Two enterprises shall be deemed to be associated enterprise if one enterprise guarantees not less than 10% of the total borrowings of the other enterprise. Here, as the percentage of borrowings guaranteed by Chapel India Limited is 40%, is more than prescribed limit. Thus, Joy Limited and Chapel Limited are deemed to be associated enterprises.
Associated enterprises.
Now, next thing. Brat Inc. of UK holds 9% of the shares in Pitt Limited of India. Okay. The total book value of assets of the Pitt Limited is 57,25,000. Okay. Brat Inc. of UK has given a loan to Pitt Limited of 30 lakhs. Examine whether Brat Inc. and Pitt Inc. are associated enterprise. What is the answer? Whether they are associated, deemed associated enterprise?
Not a deemed associated. Because it should be more than 51% of the book value of assets.
More than 51% of the
assets. Yeah. Book value of assets.
Okay. Is it not more than 50%?
Oh, sorry. Yes, it's more than 50%.
It is more than 50%. 51%. I'm sorry.
So you should not see 30 lakhs into 2. You should see 57,25,000 into 50%. The loan advance should be more than 50% of the book value of the assets. First sentence, 9%, most of them will not read the next sentence itself. Since they will think that it is 9%, less than 26%, they are not associated enterprise. They'll not even read the further line. Blunder mistakes performed by most of us. So we should not limit ourselves to read the first sentence, but continue to read the entire question and understand if there is more information to analyze the answer. Though in terms of first clause, 26% is not getting satisfied. The third clause is getting satisfied in terms of more than 50% of the book value of assets is advanced as loan. So it will become my associated enterprise. Two enterprises shall be deemed to be associated enterprise if a loan advanced by one enterprise to other enterprise is not less than 51% of the book value of the total assets. Now, in this given case, the book value of the Pitt Limited is 27,25,000. 51% of 57,25,000 is 29,19,750. Loan given by UK Limited is 30 lakhs. Hence, the loan amount is more than 51% of the book value of total assets of the Indian company. Hence, Brat Inc. and Pitt Limited are deemed to be associated enterprise. So you need to do the mathematics and then confirm. Don't even do it orally. Don't even think that I thought it was more than 50%. I thought it was more than 51%. Take your calculators, try to do the formula, apply it, and then write down the numbers and then compare. And if it is more than the limits prescribed, then conclude your answer.
Okay, sir.
Next one, Cocoa Limited supplied consumables and raw materials of rupees 300 crore to Parrot Limited. Total consumables and raw material consumed by Parrot Limited was rupees 400 crores. So what is the answer here with respect to raw material consumption? What is the limit, and is that limit getting satisfied in this?
So
Yes,
90% limit should be satisfied, sir, for raw materials.
Yeah. So is that 90% getting satisfied here?
No, sir. It
Oh,
should
sir.
be
360
90%
crores
comes
to be
around
90
360 crores.
Very good. So 400 into 90%, it should be 360. Since it is not satisfying, it will not be considered as. So two enterprises shall be deemed. Now, whenever you're writing answer, you need to write the provision first. You're observing the answers, right? First, the provision is explained, and then in the current situation, what is the limit? And then you conclude the answer whether it is getting applied or not.
Okay, sir.
Two enterprises shall be deemed to be associated enterprise if 90% or more of the raw material and consumables required for the manufacture or processing of goods or articles carried out by one enterprise are supplied by the other enterprise or by person specified by the other enterprise, and the prices and other conditions relating to the supply are influenced by such other enterprise. Here, Cocoa Limited supplied 75% of the raw material, that is raw material worth 300 crore out of 400 crore to Parrot Limited. Therefore, Cocoa Limited and Parrot Limited would not be associated enterprise. Indira Limited, an Indian company, supplied billets to Charles Limited. Billets to Charles Limited, an UK-based company, which holds 40% of the shares of Indira Limited during the previous year, 21-22. Indira Limited also supplied the same product to another UK-based company, Wales Limited, an unrelated entity. The transaction with Charles Limited are priced at euro 400 per metric ton on freight on board basis, that is FOB basis, whereas the transaction with the Wales Limited are priced at euro 700 per metric ton, cost including freight. Insurance and freight amounts to euro 200 per metric ton. Compute the arm's length price for the transaction with the Charles Limited. Now, what has happened? Indira Limited is selling billets to Charles Limited at 400 per metric ton on FOB basis, and it is also selling to another UK-based company, which is Wales Limited, at 700 per metric ton on cost including freight, cost including insurance and freight. Insurance and freight cost is 200 per metric ton, whether the transaction is at arm's length price or not. Now, how many of you know what is arm's length price, and are you able to understand this question and you will be able to answer, or you want me to explain what is arm's length price? If anybody needs the explanation, let me know quickly.
You please explain.
So please explain, sir.
Now, when we saw deemed associated enterprise or associated enterprise means somehow one entity is related with the other entity. That means one entity can influence the other entity, the decision-making power. If the product has to be sold at 10 rupees, I can ask it to be given at 9 rupees because I am the decision-making power. Half of the board of the directors is appointed by me. Now, those 5 directors out of 8 directors can act on my advice. If I tell, please release a purchase order for 9 rupees, I will release a purchase order for 9 rupees instead of 10 rupees. So this is influenced. That means it is biased, or it is not a what do we say, unbiased market condition. Now, the same thing if I go to the open market, I'll have to be more competitive. I will give it at a lesser price if somebody is giving at lesser price. If nobody is giving at lesser price, why will I give it at lesser price? To reduce my profit. If all of them are selling this product at 12 rupees, why will I go to the open market and give it 10 rupees? I will give it 9 rupees. I will give it 11 rupees or 12 rupees. I'll give it at the same price. Or I might give it a small price reduction so that people come to me. I might give it at 11.5, but I definitely not give it at 9 or 8 rupees. Correct? So that is called when a transaction is undertaken in an open market condition, which is unbiased between two unrelated parties in an unbiased market condition, and the price at which the transaction is transacted between these two unrelated parties are known as arm's length price. Okay, but if a transaction is undertaken between two related parties who are associated enterprises and there is a biased market condition, it is not considered as an unbiased market condition. So the transaction might be not at arm's length price. That is the underlying assumption. For a transaction price to be at an arm's length price, the market condition should be an unrelated market condition and it should be an unbiased market condition. And between two unrelated parties, the transaction should have transacted. Then the price in such situation is considered as arm's length price. Now, in the given example, we have Indira Limited and the Charles Limited, which are related parties. So the transaction price in the related parties could be less than the arm's length price. We need to test that. Now, the transaction between Indira Limited and the Wales Limited is two unrelated parties in an unbiased market condition and in an unrelated market situation. So that will be the arm's length price. Now we will take that transaction as a comparable transaction, and what price that transaction is transacted, we take that price as the arm's length price and see whether the transaction between related parties is happening at the same price or higher than that. It should be higher than that. If it is lesser than this price, then there will be a difference between that transaction to consider this as a transfer pricing adjustment. Now let us see. First, we need to compare whether it is associated enterprise or not. 40%. Here, since foreign company Charles Limited holds more than 26% shares in Indira Limited, both be deemed to be associated enterprise within the meaning of Section 92A, Clause 2. As Indira Limited supplies similar product to an unrelated party, Wales Limited UK, the transaction between Indira Limited and Wales Limited can be considered as comparable uncontrolled transactions for the purpose of determining the arm's length price of the transactions between Indira Limited and Charles Limited. Now, we are comparing Indira and Wales Limited transaction price as arm's length price in comparison to the related party transaction between Indira and Charles Limited. Thus, comparable uncontrolled price method of the determination of arm's length price would be applicable in this case. Transactions with Charles Limited are at FOB basis, whereas transaction with Wales Limited is CIF basis. Now I should compare apple with apple. Now here apple and orange are there. Now I cannot compare apple and orange, COB versus CIF. So I need to bring down CIF to the FOB basis. What is FOB prices? That is without any insurance and freight cost. Now 700 includes insurance and freight expense. Now if I remove insurance and freight, it will become the FOB price for Wales Limited also. Now 700 minus 200, 700 is the cost inclusive insurance and freight cost. And if I reduce the insurance and freight cost of 200 euros, then it becomes 500 per metric ton. Okay. Now, since the adjusted price for Wales Limited, that is 500 euros per metric ton, is greater than the price fixed for Charles Limited, the arm's length price will be 500 euro per metric ton. And the difference between 500 and the actual price between the related party, that is 400 metric ton, will be adjusted as transfer pricing adjustment and will be added as income to the Indira Limited. Otherwise, Indira Limited would have got $100 more, 100 more euros. Now they got only 400 euros. They simply sold for 100 euros lesser. So that means they have suppressed the income. That means to that extent, the tax is paid less in India. So they have considered this as adjustment of transfer pricing. Is that clear?
Yes, sir.
Yes, sir.
So then we have transfer pricing rules shall have no implication where the income is computed on the basis of the book profits comment. Now, if I have computed my profits on transfer pricing rule shall have no implication where income is computed on the basis of book profit comment. So I should check whether transfer pricing rules will have its impact if computed on book profit. We have, what is book profit? We have discussed yesterday, that is 115 JB, isn't it? So the statement is correct. For the purpose of computing book profit for levy of minimum alternate tax, the net profit shown in the profit and loss account prepared in accordance with the companies that can be increased or decreased only by additions or deductions specified in explanation to section 115 JB. Now, 115 JB prescribes specific additions and deductions. No other adjustment can be made to arrive at the book profit for the levy of MAT except where it is discovered that the profit and loss account is not drawn up in accordance with the relevant schedule of the Companies Act, or incorrect accounting policies and or accounting standards have been adopted for preparing of such accounts, and the method and the rate of depreciation adopted is not correct. Only in these cases the correction can be made. Otherwise, the transfer pricing rules computed based on the book profit will be appropriate. Therefore, the transfer pricing adjustment cannot be made while computing book profit for levy of MAT. So MAT, minimum alternative tax, is different when compared to transfer pricing rules. Explain how the arm's length price in relation to an international transaction is computed under resale price method as per rule 10B1 of the income tax rules. They can ask you a question as to how it can be considered in a resale price method. So there are steps given in the resale price method. I'll directly go to an example. I'll not spend any time explaining or reading this. We'll understand through an example. A sold a machine to B Limited, that is an associated enterprise, and in turn B sold the same price to C, an independent party, at the sale margin of 30% for rupees 4 lakh, but B has incurred expenses of rupees 4,000 in sending the machine to C. Here arm's length price would be calculated. How it will be calculated? And now, what is the price at which the sale margin? Margin is 30%. That means what is the sale price or the price at which it is sold? 30%. We need to calculate. Sale price to B is rupees 4 lakh. Gross margin is 1,20,000 and expenses incurred is 4,000. So if you reduce these margin and expenses, arm's length price will be called as 2,76,000. Now, if the price provided to A, if the B has paid less than 2,76,000, then the arm's length price is, then the transaction price is not at arm's length price. Here they have not given the information about at what price A sold to B. If A is selling the machinery to B at a price more than 2,76,000, then the transaction between related party is said to be at arm's length price. Now I am deriving the arm's length price based on the resale price method. What is resale price? B is reselling to another independent party by keeping a margin of 30%. The margin of 30% and the expense incurred should be reduced, and that will be becoming my cost price. And if I have got that machinery at lesser than that price of 2,76,000, then A has not sold at arm's length price. That is the understanding. Is that clear?
Yes, sir.
Yes, sir.
Anybody didn't understand this? So this is what is given here. I'll put this on the screen for a minute. Quickly go through these 5 points and see if you can relate with the example.
Sir, can you show the answer once, sir, for that question? Thank you, sir.
So if you have finished reading or trying to understand, then we'll proceed further.
It is clear, sir. We read it.
Okay. write a short note on advance pricing agreement. So you might get a question on this advance pricing agreement. We need to tell what is an advance pricing agreement. So I am based on the marks, you can decide to write how much of it needs to be written. I'm giving you 3 kinds of answers and 3 kinds of features. An APA is an agreement between a taxpayer and an authority determining the transfer pricing methodology for pricing the taxpayer's international transaction for future years. Now, what happens if a transaction is entered between an associated enterprise? Then what does it mean? In future, the tax authorities will come and check whether the transaction is at arm's length price or not. Instead of doing it in a future, when tax authorities come, before entering into a transaction, I go to a tax authority telling that I am proposing to have a transaction, so-and-so transaction between the associated enterprise. Please tell me what should be the arm's length price and which method I should be using out of the 5 methods available. Now, in the advance pricing authority will give an order telling that for this kind of transaction, this is the method that you should apply and this is the price which you should apply. Now, once that is freezed, then in future, there is no litigation. Okay. So it is blessed by the tax authority. The transaction price is at arm's length price. So in future, it is not under scrutiny or subjectivity. Okay. So an advance pricing agreement is an agreement between taxpayer and the tax authority determining the transfer pricing methodology for pricing the taxpayer's international transaction for future years. So let us see what other types of APAs. Now we have unilateral APA, bilateral APA, and multilateral APA. So when there can be a separate question on types of APA, then you need to write this. What is unilateral APA? An APA that involves only the taxpayer and the tax authority of the country where the taxpayer is located. That is Indian taxpayer and Indian tax authority. That is called unilateral APA. Bilateral APA means an APA that involves the taxpayer, the associated enterprise of the taxpayer in the foreign country and the tax authority of the country where the taxpayer is located and the foreign tax authority. That means all the 4 parties. Now, in the first case, it is only myself and my tax authority. Now, in the second case, it is 4 parties. That is associated enterprise and the other enterprise in the foreign entity and the tax authority of Indian entity and the tax authority of the foreign country. So all the 4 parties will enter and decide in what price or what methodology needs to be deployed to derive the transfer pricing price. Multilateral APA, where it will be multiple associated enterprises and multiple tax authorities. An APA that involves the taxpayer, 2 or more associated enterprises of the taxpayer in different foreign countries, tax authority of the country where the taxpayer is located, and the tax authorities of the associated enterprise. If the associated enterprise is located in Singapore and Australia and China, then the Indian entity, the Australian entity, Singapore entity, and China entity, and the tax authorities of Indian entity and Australian entity, China tax authorities, and Singapore tax authorities. All the 8 parties, then it will become multilateral APA. Unilateral APA, single entity with single tax authority. My bilateral APA, double entity with double tax authorities. Multilateral APA, more than 2 tax authorities and more than 2 corporate entities. So this are the different types of APAs. Now let us try to understand the benefits of APA. What are the benefits of APA? That once if I enter into APA, then there is no confusion. In future, the tax authority will not tell anything because the methodology is prescribed by the tax authority in the beginning itself. The certainty with respect to tax outcome of the taxpayer's international transaction by agreeing in advance, the arm's length price or transfer pricing methodologies to be applied to the taxpayer international transactions are covered by the APA. So it is very clear and it is clearly available as to what has to be done. Removal of an audit threat, minimize rigors of audit and deliverance of a particular tax outcome based on the terms of the agreement. So there is no future audit possibility. Okay, even if it is there, they will agree the price at which it is done because it is suggested by the tax authority. Substantial reduction of compliance cost over the term of the APA. If the advance pricing agreement is taken for next 10 years, then for next 10 years, compliance cost and litigation cost is reduced. For tax authorities, an APA reduces cost of administration and also free scarce resources. That means they need not deploy monitoring all these transactions because it is already taken care under the APA, and it reduces their administration costs also. That is your benefits of APA. Procedure for an APA. So when they ask about APA, you can write all these points. You can write what is an advance pricing agreement, what I discussed in the first slide. Then additionally, you can write the types of APA, benefits of APA, and procedure of an APA. An application for an unilateral agreement should be made to the Director General of Income Tax, that is DGIT in India. For bilateral APA and multilateral APA, application should be made to the competent authority in India. The competent authority will send the application to DGIT, who in turn will send it to respective APA teams. In the case of bilateral APA and multilateral APA, negotiations between the competent authority of India and other countries shall be carried out in accordance with the provisions of the tax treaties. Further, the process in India will be initiated only after filing the application with the competent authorities in the associated enterprise jurisdiction, and evidence to that effect is provided by the Indian competent authority. So this is the procedure. In case of unilateral APA, it is simpler. In case of bilateral APA and multilateral APA, first the application has to be made to competent authority. The competent authority will then refer the application to Director General of International Taxation, that is DGIT, and then they in turn will designate it to the respective teams. Now they will evaluate and discuss with the foreign countries' tax authorities in accordance with the tax authorities and decide the position. Once this is done, the competent authority in the associated enterprise tax jurisdiction has to make an application and get the acceptance, and this acceptance has to be made available to the Indian competent authority, and then the APA will be concluded. So this is the procedure for APA. Any doubts still here?
No, sir. Clear, sir.
Okay.
No, sir.
Okay, so here we have more or less completed the general anti-avoidance rules and transfer pricing rules broadly. Now, if time permits, I will solve some problems. But before that, I need to take you guys to the place of effective management before we conclude the direct tax. So we'll go to place of effective management rules. Give me a minute. Good. So we are here with the place of effective management. Okay. So do you all need a quick 5-minute break and then start with this? So once we conclude this, we'll be going to the part 1 of the advanced tax practice.
Yes, sir. Break.
So we'll resume back in next 5 minutes and then we'll continue this. I need around 20 to 25 minutes for completing this. And then we'll start with the part 1.
Okay, sir.
Okay, sir.
Okay, I'm back. Can we continue?
Yes, sir.
Yes, sir.
Okay. Now, the place of effective management is coming from the concept of residential status, like we have discussed in one of the chapter yesterday, topic 1 or topic 2, where we were discussing about taxation of companies. So all resident companies are considered to be, all Indian companies are considered to be resident in India, and all non-resident companies or foreign companies or body corporates can be considered as resident in India if they satisfy the following conditions. So that is what is the first statement. How the residential status of a company would be determined under Income Tax Act. As per Section 6, subsection 3 of the Income Tax Act, a company is said to be resident in India in any previous year if it is an Indian company. If it is an Indian company, and it is place of effective management in that year is in India. That means either the place of effective management of that year should be in India. That is for any company, or if it is an Indian company, you need not check the place of effective management. Always it is resident in India. The place of effective management is defined in the Act to mean a place where key management and commercial decisions that are necessary for the conduct of business of an entity as a whole are in substance made. Okay, so place of effective management is defined means the key managerial and commercial decisions which are necessary to the conduct of the business are taken are in substance made. So we discussed also one question yesterday that the board of directors in UK are delegated the powers to people who are sitting in Delhi. So Delhi people are taking the decision. So the place of effective management is said to be in Delhi. So we have seen that in that aspect. Now let us try to see some more practical questions. ABC Inc. ABC Inc. is a Swedish company headquartered at Stockholm, not having a permanent establishment in India, has set up a liaison office in Mumbai in April 2021 in compliance with the RBI guidelines to look after its day-to-day business operations in India. Spread awareness about the company's products and explore further opportunities. The liaison office takes decision relating to day-to-day routine operations and performs support functions that are preparatory and auxiliary in nature. The significant management and commercial decisions are, however, in substance made by the board of directors at the Sweden. Now, what do you feel? Is the place of effective management is in India or is it in Sweden?
It's in Sweden.
Okay.
As the management and commercial decisions are taken there.
Okay. So how do you write the answer? You write an answer first. Section 6 subsection 3 provide that company would be resident in India. You write the same logic that it is an Indian company or place of effective management of that in that year is in India. In this case, ABC Inc. is a foreign company. Therefore, it would be resident in India for previous year only if its place of effective management in that year is in India. Now, since it is a foreign company, you need to check. Explanation to section 6.3 defines place of effective management. And we have seen the definition. In the case of ABC Inc., its place of effective management for previous year 21-22 is not in India, since the significant management and commercial decisions are in substance made by the board of directors outside India in Sweden. Hence, it is not in India. ABC Inc. only has a liaison office in India through which it looks after routine day-to-day operations in India. The place where decisions relating to day-to-day routine operations are taken and support functions that are in preparatory or auxiliary in nature are performed are not relevant in determining the place of effective management. The key and commercial decisions are important. Day-to-day operating decisions are just in preparatory and auxiliary in nature. Those are not relevant for deciding the place of effective management. Hence, ABC Inc. being a foreign company is a non-resident for assessment year 22-23 since its place of effective management is outside India in previous year 21-22. Next thing, company company A, that is a company is a outsourcing entity for an Indian multinational group incorporated in country X and is 100% subsidiary of Indian company. Okay, company ACO is a sourcing entity for an Indian multinational group incorporated in country X and is 100% subsidiary of the Indian company B company. Now A company is in which country? Country X, and is it? It is a subsidiary company of Indian company. So Indian company is a holding company. What is the holding company name? B company. The warehouse and the stock in them are only assets of the company and are located in country X. The warehouse and stock in them are only the assets. That means the company A in country X has only warehouse and stock, and those are the only assets. All the employees of the company are also in country X. All the employees are also in country X. The average income-wise breakup of the company is total income for 3 years is shows as under. 30% of the income is from transaction where purchases are made from parties which are non-associated enterprise and sold to associated enterprise. 30% of the income is from transactions where purchases are made from associated enterprise and sold to associated enterprises. And then we have 30% of the income from transaction where purchases are made from associated enterprise and sold to non-associated enterprise. The first one is purchased from non-associated enterprise and sold to associated enterprise. The second one is purchased also from associated and sold also is to associated enterprise. The third one, purchased from associated and sold to non-associated enterprise. 10% of income is by way of interest. In this case, the passive income is 40% of the total income. Now, what is passive income? Passive income should be more than 50%. So passive income is where both are associated enterprise and interest income, 30% and 10%. That is category 2 and 4 are considered as passive income. 1 and 3 are not considered as passive income. The A company satisfies the first requirement of the test of active business outside India. Since no assets or employees of A company are in India, the other requirements of the test is also satisfied. Therefore, company is engaged in active business outside India. Now, all of you are aware of the active business outside India test conditions? Quickly, can you confirm? Otherwise, you will not be able to understand this. Yes, I am waiting for your answers. Are you aware of the concept of active business outside India?
Yes, sir.
Yes, sir.
Yes, sir.
So active business outside India is told when passive income is not more than 50% and less than 50% of the total assets as in India and less than 50% of total employees in India or are resident in India, less than 50% of the payroll expenses. So you have 4 conditions. What are the 4 conditions? Passive income in India is not more than 50% and assets in India is less than 50% and employees is less than 50% in India and payroll expenses is less than 50% in India. If these 4 conditions are satisfied, then it is considered as active business outside India. Now let us try to understand this. Here, they've told all employees of the company are also in country X. That means less than 50%. That condition is satisfied. And also they say warehouse and stock in them are only assets of the company that are located in country X. That means they have only warehouse and stock, and that is the only asset. That the entire asset is in country X. Nothing is in country India. So the assets are completely outside India. Since complete employees are outside India, so entire payroll cost is also outside India. All the other conditions satisfied. Now the passive income should be less than 50%. Now here it is 40%. Since all the conditions are satisfied, we can tell the company is engaged in active business outside India. If the active business is outside India, then place of effective management is not in India. Now let us try to understand. The other facts remain the same as that in example 1, with variation that a company has a total of 50 employees, 47 employees managing the warehouse, storekeeping, and accounts of the company are located in country X. Okay, that means outside India, 47 employees. The managing director, chief executive officer, and sales head are resident in India. The total annual payroll expenditure on these 50 employees is 5 crores. The annual payroll expenditure in respect of MD, sales head, and CEO is 3 crore. Now what happens? One condition is getting modified. Earlier, all the four were satisfying. Now there is a new improvisation in the employee criteria. Out of 50 employees, 47 are outside India. That means number-wise, more than 50%. That is, more than 50% of the employees are situated outside India. That means in India, less than 50%. Only 3 are situated. Now, the payroll cost, the fourth condition, the payroll cost should be less than 50%. Now, what is the total payroll cost? 5 crores. That means less than 2.5 crores should be in India. But here what we see, 3 crores pertains to 3 people, MD, CEO, and sales head, which is more than 50%. That means the condition of payroll expense being less than 50% in India is not met. Although the first limb of the active business test is satisfied by company A, that is only 40% of its total income is passive in nature. Furthermore, 50% of the employees are also situated outside India. All the assets are situated outside India. However, the payroll expenditure in respect of the MD, CEO, and sales head being employees resident in India exceeds 50% of the payroll total expenditure. So therefore, company A is not engaged in active business outside India. Since it is not engaged in active business outside India, then it will become having place of effective management in India. We'll move to the next example. Now, furthermore, change to the facts. The basic facts are same as in example 1. Further facts are that all the directors of the company A are Indian residents. During the relevant previous year, 5 meetings of the board of directors is held, of which 2 were held in India and 3 held outside India, with 2 in country X and 1 in country Y. That means now all the board of directors are situated in India, but board of directors meeting were held in India. Out of that, 2 were held in India and 3 were held outside India, with 2 in country X and 1 in country Y. Okay, country X and country Y. So, interpretation, the company A is engaged in active business outside India, as the facts indicated in example 1 established that the majority of the board of meetings have been held outside India. The condition is that if the board of directors are sitting in India, the majority of the board of directors meetings should be held in India. Out of 5, 3 should have been held in India, but here it is only 2 which is held in India, the other 3 which is held outside India. So it is considered as active business outside India. The facts are same as in example 3, but it is established by the assessing officer that although a company's senior management team signs all the contracts for all the contracts above rupees 10 lakhs, the A company must submit its recommendation to B company, and B company makes the decision whether or not the contract may be accepted. It is also seen that during the previous year, more than 99% of the contracts are above 10 lakhs, and over past years also the same trend in respect of value contribution of contracts above rupees 10 lakh is seen. Now, these facts suggest that the effective management of the company A. What is company A? Company A is Indian entity or foreign entity? Can you tell me quickly? A company, is that foreign entity or an Indian entity?
Foreign entity.
Foreign entity. B company is an Indian entity, that is holding company. Okay, so the facts suggest that effective management of A company may have been by the parent company B company. Therefore, place of effective management of A company may in such cases may not be presumed to be outside India, even though A company is engaged in active business outside India and majority of the board of directors meeting are held outside India, because the decisions are influenced by A company in India through B company, because all the contracts which are more than 10 lakhs need to be ratified or permission to be obtained from the holding company which is situated in India, that is B company. Now B company has to provide the permission for all the value of contracts which is more than 10 lakhs. And the trend has seen that 99% of the contracts are more than 10 lakhs. That means 99% of the decision or the management of the 99% of the company is completely done by a company in India, that is B company. So the effective management of company A is actually happening in India. So the company A is said to have place of effective management in India, even though the active business test is outside India. So it will be considered as having business residential status in India. An Indian multinational group has a local holding company. So this is a new example altogether. Indian multinational group has a local holding company, that is A company, local holding company in country X. The A company also has a 100% downstream subsidiaries, B company and C company in country X and D company in country Y. Okay. The Indian multinational group has a local holding company, A company, in country X. The A company also has 100% downstream subsidiaries, B company and C company in country X and D company in country Y. The A company has income only by way of dividend and interest from investments made in its subsidiaries. That is in country X and country X and country Y. The place of effective management of A company is in India and is exercised by ultimate parent company of the group. The subsidiaries B, C, and D are engaged in active business outside India. The meetings of board of directors of B company, C company, and D company are held in country X and Y respectively. Now here it is looks like very complicated, but it is very simple. You need to see merely because the place of effective management of an immediate holding company is in India, the place of effective management of subsidiaries shall not be taken to be in India. Each subsidiary has to be examined separately. And as indicated in the fact, since companies B company, C company, and D company are independently engaged in active business outside India, and majority of the board meetings of these companies are held outside India, the place of effective management of B, C, and D shall be presumed to be outside India. We should not get, if you don't know the provision, you will feel that since holding company's place of effective management is in India, the subsidiary's place of effective management will deem to be present in India. So you need not get confused. The subsidiary company's place of effective management has to be seen independently from that of the holding company, and the clear indication is given that B company, C company, and D company's active business is engaged outside India, and the majority of the board of directors meeting are held outside India. Is that clear? Can we proceed to the last question? Any doubts still here?
No, sir. Yes, sir.
Yes, sir.
XYZ Limited, a foreign company, has its head office at USA. Okay, the board of directors meetings are held in USA. However, the board of directors has delegated major powers to a committee in Kolkata, and the members of this Kolkata are based in members of this committee are based in Kolkata. The board of directors ratified the decisions of the said committee in the light of the above. Discuss the place of effective management of XYZ Limited. Discuss the guidelines, factors of POM of board of directors delegating authorities to the committee. Did we see this question yesterday also? Similar question. Delhi. It was Delhi.
Yes, sir.
Today it is
Delhi.
Kolkata. Yeah. Okay.
Kolkata.
The location where company's board of directors regularly meets and makes the decision may be the company's place of effective management, provided the board retains and exercises its authority to govern the company. And does in substance make the key management and commercial decisions necessary for the conduct of the company's business as a whole. In the given case, the board meetings are held in USA, but the same formalize the decisions taken by the committee at Kolkata. Hence, the place of board of meeting held at USA cannot be place of effective management, as power is delegated to committee. Guideline factors when board delegates the authorities to committee are as under. If the board director had delegated some or all of its major authorities to one or more committees, then the members of the executive committee, wherever they are staying, that place will be considered. Where committee develops and formulate key decisions for formal approval by board, that place will be considered as place of effective management. Since they are situated in Kolkata and that committee is taking decisions in Kolkata, hence given case POAM of XYZ Limited will be Kolkata as discussed in the above provisions. Any doubts on this until now?
No, sir, clear, sir.
No, sir.
Sir,
Yeah.
sir, if they are not situated in Kolkata but are taking decisions in Kolkata, then it will not be place of effective management in Kolkata, right?
You'll have to see where members of executive committee are based. Where committee develops and formalize the key decisions for approval by the board. Where the decision is taken.
If the decision is taken in Kolkata, but they are not resident of Kolkata, but some other country, then it will not
Then
be
Kolkata.
Kolkata.
No. Then Kolkata only. No problem. Where the
because
key decisions are taken.
But both the conditions should be satisfied that they are in Kolkata, resident in Kolkata, and as will take the decisions in Kolkata, no, sir?
So that is one of the things. Now we'll have to see the residential status of the members.
Okay.
Okay, so we cannot tell, say, for example, he is staying in India for more than 182 days, but he is frequently traveling to Sri Lanka. He comes to Bangalore or Chennai or Kolkata and takes the decisions and goes back to Sri Lanka. He keeps on rotating, but he is based out of Kolkata. So even then, in that case, it will be considered as, since the decisions are taken and he is based out of Kolkata, though he is situated, though he is not permanently situated in Kolkata, it will be considered as members are based out of Kolkata.
Okay, sir.
Okay, quickly, we'll see if there are some problems to take up before we proceed. Okay, let me share a pointer here. 1 second. So I've put up the topics for GST here. These are the topics that are available for GST. Can you quickly tell me which of the concepts are clear or not clear, or where you have difficulties? So we'll take up those topics first, and then we will come back to other topics where you have difficulties. Or is it clear? I think most of you had told that GST you are comfortable. So you can let me know which topic is required for you to solve or discuss, then we'll discuss those topics. Or where you are finding challenge, if you have any doubts or any challenges, we can take up those pointers quickly to resolve the things.
With respect to time of supply and place of supply, for solving the questions even, that will be more helpful if you brief it.
Okay.
So as well as the assessment, audit, scrutiny and inspection, that 5th and 6th lesson, no, sir. That is more vague to study. So I didn't concentrate more on that. So
Okay.
if you explain that, it will be good.
Sir, if you can revise the 4th chapter, even the 4th.
Procedural compliance, the returns and all of that. Okay.
Sir, and the customs law.
Okay, customs is only for 10 marks. Anyways, we'll quickly run through those. We have around 10 to 15 questions in there. We'll run through that, not an issue. Okay, good. So we'll come back to these concepts first before we go to the other concepts. Once we finish the other chapters, give me a minute.
So, and I have a question.
Yeah.
In the computation of arm's length price, you have explained about the resale price method with some examples.
Correct.
But there are 4 to 5 methods were there. Do we have to do the sums regarding the methods, or only we should know the meaning and some
So you
basic
should know the problems also.
Okay. Except resale price method, we should also know the balance 5 methods.
Correct.
Sums also. Okay.
Correct. That's what I'm trying to see if I have some problems to solve now in transfer pricing.
Yes, sir. It will be more helpful if you solve one sum with that one method.
Yeah.
Sir.
Yeah.
Sir, in GARR lesson, under SARR, they had given some key provisions in the material called bond washing, dividend stripping, and clubbing of income. Like, are there just some examples of SAR, or they are the only key provisions there?
They are one of the examples for SAR.
So if they ask us any question regarding SAR, we can take these three
Bond
topics.
washing, dividend stripping, you can explain those. Those are all specific anti-avoidance rules.
Okay, sir.
Okay, so here you have the next question. So ABC Limited is engaged. ABC Limited is a foreign company, foreign subsidiary company of XYZ Limited, and XYZ Limited sells refrigerators to ABC Limited at a price of rupees 10,000 each for sale to its dealer in Singapore. Okay, in other states, XYZ Limited is directly selling to their dealers at rupees 12,000 with a warranty of 1 year, that is 500 for each fridge. ABC Limited does not offer such warranty. Quantity sold to ABC Limited is 8,000 units and to dealers of XYZ Limited is 3,000 units. Discuss the method to be applied to arrive the arm's length price and compute the arm's length price. How the assessment of XYZ Limited going to be affected? Now, ABC Limited is a foreign subsidiary. That means ABC is a foreign entity. XYZ is an Indian entity. XYZ Limited sells refrigerators to ABC Limited. Now, we need to compare the two transactions. First of all, let me outline the different methods that are there for you to get a comfort. Comparable, uncontrollable price method. Comparable and control price method. Then you have resale price method. And then we have cost plus method. And then we have profit split method. Then we have transactional net margin method. So popularly known as CUP, cup method, RPM, resale price method, CPM, cost plus method, profit split method, TSM, transactional net margin method, TNM. Okay, these are popularly called names. And popularly used are these only these things: comparable transaction price method, cost plus method, and transactional net margin method. Resale price method and profit split method are very rarely used and not practically applicable in most of the cases.
Sir, we did one sum for the resale price method previously.
Correct, theoretically, correct.
Yes.
comparable uncontrolled price method. So in this problem, this is comparable. When does comparable control uncontrollable price method? When you have a comparable transaction. We saw that 700 metric ton and 500 metric ton, right? Charles Limited and Wales Limited. That is kind of here also similarly we have comparable transaction. ABC Limited is selling, getting purchased from XYZ Limited. Same XYZ is also selling to the dealers and also the selling it to the related party ABC. So there is a comparable transaction. So we need to compare at what price XYZ is selling to its dealers, whether at the same price it is selling it to the Indian or the foreign related party. So this method, first of all, discuss the method to be applied. That is, we have the method which is known as comparable uncontrolled price method. Now, how are we going to determine the price? We are going to determine the price in such manner. So you can write down sale price charged by XYZ Limited to its dealers. Okay, this will be my comparable transactions. How much it is charging? 12,000. But it gives a warranty to its dealers, but it does not give warranty to ABC. So we need to reduce the warranty cost embedded less warranty cost provided to dealers, but not to the ABC Limited. How much is that? 500. Then becomes arm's length price of 11,500. $12,000 minus 11,500. What is the transaction price? Transaction price with associated enterprises 10,000. So difference, that is a reduction in income by XYZ Limited, is 1,500. So number of units sold to XYZ Limited, sorry, sold to ABC Limited is 10,000. How many units? 8,000. So value of transfer pricing adjustment in the hands of XYZ Limited is ₹1,20 lakhs. So they asked the question as how is the assessment of XYZ Limited is going to be affected. So I need to write that 1,500 into 8,000 units. 1,500 into 8,000, 1,20 lakhs. 1,500 into, I get 1,20 lakhs. So this addition will be made in the computation of XYZ Limited as income, and tax needs to be paid by the XYZ Limited. Quickly write down.
Done, sir.
Okay. So practically questions are coming. So practically what I told, comparable and comparable uncontrollable price method, cost plus method, and transactional net margin. This is real life scenarios or in the industry practical world. These are the three commonly used methodologies. But when it comes to examination, cost plus method and transactional net margin method, if they have to ask, it should be minimum 15 to 20 mark question. It is a very big calculation technology, because of which they are not asking any question on cost plus method and transactional net margin method in examination. They are restricting to cost plus method and resale price method because it is very simple to answer. Since profit split method is not widely used in the market in the industry, so they're not asking any questions on the profit split method. They can ask a theoretical question. So thereby, if you understand comparable uncontrolled price method and resale price method for your examination, that is more than sufficient.
Okay, sir.
Okay, any more questions that you have, or you have any clarifications? I'll give you 5 minutes time. You can go through all the syllabus for direct tax and international taxation. If you have any clarifications on any chapter or any concept, you can let me know. We'll quickly go through it before we proceed to part 1, GST and customs. For GST and customs, I think you have a recent material given by the ICSI, which is relevant for December 2022. And I think that has covered most of it with a very beautiful thing. Have you gone through that material? Have you all solved that thing? Yes, no?
So you mean the new material book or the question paper guidance?
Some practical questions are given, which is relevant for December 22.
I didn't solve it yet, sir. I don't know about the others.
Okay.
Sir, I solved some of them, sir, but some chapters are mixed in that.
Okay. Good. What about others? I think that is a very good reference material. I will also try sharing that, and we'll also be solving some problems from there, and we'll revise the question and answer format from that material in the later today, so that you will have a control of it. We'll finish that. We'll try to finish that entire material, and we'll see where we will head towards it. we'll try to discuss that. So if you have had the basic understanding and if you're comfortable, we can run through quickly and faster and then proceed further. Wherever you feel that it is you're clear and this need not be explained, then you can let me know so that I can be a little more faster to proceed further.
Okay, sir.
In direct tax, anything left?
So far, no, sir. If you have any doubt, we'll ask in the end of the session.
Okay. So we'll do it in a different way for indirect tax. So I want all of your active participation. So I want all of you to see the screen and read out or give your analysis and provide your understanding as well. And then we'll discuss whether your view is correct or not, or what is it going to be there. So I want more interactive in this session. So we'll resume exactly at 12:45. So if you want to take a quick turnaround and come back with the water sipping and all of that, so you can just come refreshed, and we'll start at 12:45 exactly the all the 10 topics of indirect tax.
Okay, sir.
Do you all ready?
Yes, sir.
Yes, sir.
Okay, we'll start with supply. Okay, so when we start with supply, what is the kind of understanding that we need to get? We need to see there are two things. One is the taxing event and the time. Okay, the time of supply and the place of supply. The time of supply and the place of supply is very important for this chapter, where we need to see that is when the triggering for collection of GST will be coming into picture, and where value of supply is the next concept. So one is, first we need to see the point of time and the completion of supply, that is supply of the time of supply and the place of supply. Then time of supply determines when we need to tax, place of supply determines where we need to tax, and then once these two things are completed, we need to proceed further in terms of the value of supply. What is the value of supply? We need to determine as to how much is the quantum of supply. So these are the kinds of different terminologies which are important. So first thing, let us try to understand the taxable event. So when I say the taxable event, what is the taxable event? The scope of the term supply under GST. The taxable event is any transaction or occurrence that results in tax consequence. So first of all, I need to have a tax consequence. First of all, it need to have a applicability of a tax. The taxable event under GST shall be supply of goods or service, or both, in terms of Section 7 of the CGST Act. So either it can be supply of goods or it can be provision of service or supply of service. Either of these two should happen in order to trigger the collectability of a tax, that is called as taxable event. The taxable event under the existing indirect tax laws, such as manufacturing, sale, or provision of services, shall stand subsumed in taxable event known as supply. Okay, earlier it was termed as supply, manufacture, sale, provision of service, and all of that. Now it is completely known as supply. The term supply is wide in its import. That means, in its sense, covers all forms of supply of goods or service, or both. That includes, it can be sale, transfer, barter, exchange, license, rental, or disposal, or any lease made or agreed to be made accordingly by one person to another person for furtherance of business. That means it should be in the course of normal business activity or ordinary course of business. It includes import of service for consideration, whether or not in the course of furtherance of business. It also includes transactions specified in Schedule 1 made without consideration. So this is the kinds of taxable event of supply. Define the term taxable event. When all it can be considered as taxable event, it can be the supply includes it can be sale, transfer, barter, exchange, lease, rental, disposal made or agreed to be made accordingly for a consideration for the furtherance of a business. It also includes import of service. So these are the events of taxable event, or these are the consideration in which the supply is termed as is completed. What are the necessary elements that constitute supply? So can one of you start reading this? What is the supply? So you can quickly read this and let me know if you have any doubts on this.
Clear, sir.
I want somebody to read out loud.
In order to constitute a supply, the following elements are required to be satisfied. The activity involves the supply of goods or services or both. The supply is for consideration unless the transaction is covered by Schedule 1 to the CGST Act. The supply is made in course of furtherance of business, except in case of import of services. The supply is a taxable supply and the supply is made by a taxable person.
So it is very clear. It includes both supply of goods and service. And it also says that it should be for a consideration other than exempt, which are considered under Schedule 1. It should be for furtherance of business, except in case of import of service. And it should be taxable supply, and it should be made by a taxable person. It is same thing summarized in a different pointer way of the above question. Same thing, it is summarized in a different way. Distinguish between composite supply and mixed supply. Composite supply and mixed supply. So there are two things. One is composite supply and mixed supply. So let us say composite supply is composite of different goods and services. Now, if you go to a hotel, you get a composite of services. You get food, you get the place to stay, and you get equipments to use. You have the services of laundry, you have the services of gym, you have the services of yoga center. So these are all composite services. Okay, so that is called composite supply. So you are getting services in terms of composite way. Okay, let us try to understand. In terms of section 2, subsection 30, the CGST Act Act 2017 defines composite supply means a supply made by a taxable person to a recipient consisting of two or more taxable supply of goods or service, or both, or in combination thereof. That means one or two service: yoga service, gym service, laundry service, accommodation service, food service, restaurant service, massage service. All of these are considered as more than one service, which are naturally bundled. Very important. Now, there is no option. I'll have to bundle this naturally. I cannot tell I want only gym service, so I will come to your hotel. They say we don't have outsiders allowed, sir. If you are staying in our hotel room, then only you will get the gym service. I go there and I say I want to use the yoga center. They say no, this yoga center is specifically available only for the participants or the guests who are staying in our hotel rooms. So it is called naturally bundled. Now, if I go to a hotel and I tell I don't want AC, you don't charge me for AC. You charge me only for bed. I don't want any other additional service. I don't want the locker. I don't want the heater. I don't want the other services that are available. I don't want the intercom. I don't want the room service. I don't want anything. I want to just sleep for the night, and then in the morning I want to leave. So only charge me for that. So they don't allow that way to provide the service in whatever way the customer wants to ask. They say it is all bundled. It is naturally bundled. If you come here, you have all the service. You get the intercom service, you get the laundry service, you get the heater, you get the locker, you get the all laundry service, everything. So it is naturally bundled. That is when it is known as composite supply. Otherwise, it cannot be composite service. Okay. But if you go to there are hotels which has the separate restaurant and separate lodging facilities. So both are not naturally bundled. Either if I want to use only the food service, I can go there in the restaurant, dine in, eat, and then leave. At the same time, I have hotel, but I go to hotel, then I have the facility of having breakfast in the same restaurant. So this is called naturally bundled. But when I go for only food, it is not bundled that I want to stay in the room. I can only have food and come back. And bundled and supplied in conjunction with each other in ordinary course of business, one of which is a principal supply. So what is the principal supply? The hotel accommodation is the principal supply. The other things are combined in junction as a bundled services. Okay. The illustration of composite supply appended to section 230 is as follows. Where goods are packed and transported with insurance, the supply of goods, packing material, transport and insurance is a composite supply, and supply of goods is a principal supply. What is the supply of goods? Where goods are packed and transported with insurance. Now, when I go and buy a good, they say we will make it delivered at your doorstep, and installation is also given and insurance is also given. So packing, transportation, installation and insurance is called composite supply, and principal supply is the purchase of good, the supply of good. So that is called composite service. In terms of section 2 subsection 74 of the CGST Act 2017, mixed supply means 2 or more individual supplies of goods or service or any combination thereof made in conjunction with each other by a taxable person for a single price, where such supply does not constitute a composite supply. The illustration of mixed supply: a supply of package consisting of canned foods, sweets, chocolates, cakes, dry fruits, accreted drinks and fruit juice when supplied for a single price is a mixed supply. Now I come up with a hamper, say food hamper. Okay, I put some sweets, chocolates, cakes, dry fruits, the fruit juice, drinks, everything in one bundle, and then I do a bundled pack. Okay, and I say for entire package this is the price, but this can be sold separately. Somebody can come and buy only juice, somebody can come and buy only chocolate, somebody can come and buy only cake. Everything can be done independently, but I am doing it as in a packed manner to sell in a different package. So that is called a mixed supply. Each of these items can be supplied separately and is not dependent on any other. It shall not be mixed supply if these items are supplied separately. The tax liability on composite or mixed supply shall be determined in the following manner. The composite supply comprising 2 or more supplies, one of which is principal supply, that is, supply of goods is the principal supply, shall be treated as supply of such principal supply. Hence, in case of composite supply, the tax rate applicable to principal supply would be applicable to entire supply. Now, insurance is there, transportation is there, packing is there, and installation are there. These are 3 are the service, and one is principal supply is goods, buying the goods. Now the tax rate applicable to the goods will be applicable for all this composite supply, and in case of mixed supply it will be different. Okay, comprising 2 or more supply shall be treated as supply of that particular supply which attracts the highest rate of the tax. Hence, in case of mixed supply, highest tax rate as applicable to any single supply would apply to all the supplies. Now, I have chocolate, I have drinks, I have cake, I have dry fruits, I have fruit juice, I have canned sweets, everything. Now, out of these 6 products, whichever product is having a highest rate, that rate will be applicable for the entire value of the supply that I am giving to the customer. Is that clear now? Difference between composite supply, mixed supply, and the tax rate as applicable to composite rate and mixed supply.
Yes, sir.
Yeah.
Yes, sir.
Yes, sir.
2, 3, 4, 4, 5, 6, 7, 8, 9, 10, 1, 10. 3, go.
So can you here differentiate?
We can make out the 4th one.
Yeah. So give your answer for all the 4 quickly. Sale of car with warranty coverage, gift pack with chocolates and books.
It's a composite.
Sale of refrigerator with power stabilizer.
First one is composite supply. Second one is mixed supply.
Okay.
Again, third one is composite supply. Fourth one, 2 composite supply.
Okay. What about others? Any different answer?
No, sir, it's
No, sir.
correct.
See, a refrigerator and power stabilizer can be sold separately. It is not composite. A refrigerator and power stabilizer are not inseparable and are not bundleable to natural necessities. They are mixed supplies. So, gift pack with chocolates is also mixed supply as stored correctly. Only the first and last one is composite. The second and third are mixed supply. Now, what is a deemed supply? Explain with example. Deemed supply means event or transaction where no or inadequate consideration is received for the supply of goods or service. That means if it is given on free, or if it is given as gift, or if it is given as at an inadequate consideration. Say, for example, I am purchasing a pen at the MRP of the pen is 100 rupees. But since I am attending a conference, they are giving that pen at a subsidized price of 90 rupees. So that is called inadequate consideration. So the deemed supply will be for entire 100 rupees. The person who is giving this pen at 90 rupees has to pay GST on the entire 100 rupees. Let us see. Schedule 1 under Central Goods and Service Tax Act 2017 are given with respect to examples. Activities to be treated as supply even if made without consideration. That is exempt supply or without consideration. Permanent transfer or disposal of business assets where input tax credit has been availed on such assets. That means I had purchased machineries, I had purchased laptops, furniture, and equipments, and I had claimed the input tax credit. Okay. Now, after 3 years, I am transferring this business as a whole and transferring all the assets. Now, what happens when I'm transferring this business assets to business as a whole? Now, the input credit was enjoyed by me. Okay. So this entire value of the furniture and equipments and machinery has to be sold to another person with a consideration of charge or GST. Okay. For example, Mr. A sells air conditioner. He transfers one AC from stock in trade to his home for personal use, would constitute as supply. See here. Now, this is a different example. Now, he is having an air conditioner shop. So he transfers one air conditioner at free of cost to his home. He cannot do that. Now, from that also, you need to pay the GST. Scrap of machinery destroyed by fire handed over to insurance company for settlement of claim. Since ITC has been availed, so when the machinery destroyed by fire is handed over to insurance company in return for insurance compensation, is also a supply of goods. So these are the kinds of examples that is given. Supply of goods or service or both between related person or between distinct person as specified in section 25, where when made in the course of furtherance of business. Provided that gifts not exceeding 50,000 rupees in value in a financial year by an employer to employee shall not be treated as supply of goods or service or both. Now, in COVID time, all of you had seen that all of them had given work from home allowance, or they told you can buy table, chair, or laptop, internet, Wi-Fi, everything. If the value of such benefit given is less than 50,000, then it is not considered a supply of goods. Otherwise, it is considered a supply of goods and the employer is required to pay GST. Or if any benefit is given, say for example, employers are giving goodies or in terms of rewards. If those rewards are more than 50,000 rupees, then it is taxable and it is considered as supply. Now we have other concepts as supply of goods in case of principal and his agent concept, which we need to consider here. And import of service by a person from related person or from any of his other establishments outside India in the course of furtherance of business. We saw that already, that supply definition itself, import of service other than furtherance of business is also considered as supply. For example, X Limited USA is a holding company of Y Limited India, and Y Limited imports business consultancy service from A Limited in the course of furtherance of business. Then the aforesaid importation of service shall fall within the ambit of term supply, and Y Limited shall be liable to pay IGST. Though the supply is given by the holding company, that is X Limited, but it is imported by Y Limited in India. Since X Limited is not registered in India, Y Limited is required to pay GST on the import of service. So that is the concept of import of service. Are we clear there?
Yes, sir.
Yes, sir.
So quickly, can you answer these 4 situations? Discuss whether GST would be payable in the following independent cases.
Sir, are these pure agent questions?
First one is of pure agent one.
Yes. Correct. Just quickly, can I have the answer for the first one?
Company secretary is acting as pure agent here.
Yes.
And
Sir, it's leviable on this 15,000, but not on the 3,000.
Exactly. So in view of the same, where the Rule 33 of CGST Act 2017 provides that expenditure or costs incurred by supplier as a pure agent of the recipient of supply shall be excluded from the value of supply. In view of the same, GST is payable only on rupees 50,000 and not on rupees 3,000, which were paid by him while acting as a pure agent. Okay. So I request all of you to be on mute. Whenever you speak, you unmute yourself, and once you finish speaking, you will have to unmute yourself. Go on mute once you finish. Whenever you want, you can unmute. The answers, then the next situation is that a pharma company supplies free samples to doctors. So what do you feel here? Free samples to doctors should be considered as chargeable to tax?
No, sir, because it is without consideration and does not fall under any item in Schedule 1.
Okay, let us see the answer. The answer to the question of taxability can be given after referring to Schedule 1 or Section 7 of the CGST Act. According to Section 7, includes all forms of supply of goods or service or both made or agreed to be made for consideration by a person in the course of furtherance of business. Schedule 1 specifies activities made or agreed to be made without consideration, and as per the supply made without consideration to unrelated person will not be treated as a supply. Therefore, GST will not be levied on free samples distributed because it is not considered as supply. However, ITC on such purchases are not allowed to the supplier. Then comes renting of community hall by charitable trust is exempt from GST as rent is less than 10,000 per day. Now here you need to understand if the rent is more than 10,000, then it is chargeable. The exemption notification number 12/2017 gives as exempted that the said service wholly from GST. The said notification provides exemption to services by a person inter alia by way of renting of premises of a religious place meant for general public owned or managed by an entity registered as a trust or as an institution under Section 1023C of Income Tax Act. However, this exemption does not apply where renting charges of premises or community halls or Kalyana Mandapam or open areas are more than 10,000 per day. So if it is less than 10,000, it is not taxable. Here, if you see in the question, it is given, what is the amount? 9,500. It is less than 10,000 for a Diwali Mela. So it is exempt. The next thing comes in terms of GTA. What is the GTA question? North Star Trucking has given on hire 11 trucks to Jaggi Transporters of Mumbai for transporting goods in various parts of the country. The hiring charges for the trucks are rupees 10,200 per truck per kg. So here, do we have any reverse charge mechanism here? The exemption notification state that provides exemption to services by way of giving hire on inter alia to goods transport agency a means of transportation of goods. In the above view, it is of that not payable if it is hired to the same goods transport agency. One agency is giving on hire to the other agency, so it is not taxable. If it was others, then it is taxable. Are we clear? Any doubts on these 4 instances?
No, sir.
No, sir.
So this is again similar one, time of supply. Okay. Here we need to understand, all this time we are understanding the definition of supply. Now we need to see what is the time of supply. When I say time of supply, what is the period, the date? Okay. Yes, SAR Limited supplied goods to Shiva Limited. The terms of the contract stipulated that goods are delivered to the factory of Shiva Limited. Okay. Goods of the goods were moved from factory of SAR Limited on September 9th, 2021 and were delivered to the factory of S Limited on September 15th, 2021. Now the invoice was issued on September 18th, 2021 and the payment was credited to SAR Limited account on October 20th, 2021. However, the entry was made in the books when the check was received, that is on September 19th, 2021. Determine the time of supply. What is the time of supply? The terms of the contract stipulated that goods are delivered to the factory of Shiva Limited. So as soon as the goods get delivered, the time of supply, that is the time, it is the right time for registration or collection of tax. Okay. So as per section 12, subsection 1 of CGST Act, the time of supply of goods shall be earlier of the following dates: the date of issue of invoice by the supplier or the last date on which he is required to issue invoice under section 31, the date on which supplier receives the payment with respect to the supply. However, advance received in respect of supply of goods is not liable to be taxed at the time of receipt. Wide notification number 66. In case of service, if advance is received, that money received date will become the time of supply. Therefore, the date of payment in respect of supply of goods shall not be relevant for determining the time of supply. Further, section 31 of the Central Goods and Service Tax provides that a registered person supplying taxable goods shall issue a tax before or at the time of removal of goods for supply to the recipient, where the supply involves movement of goods or delivery of goods or making available thereof to the recipient in any other case. So as per section 31, the invoice should be raised at the time of removal or at the time of delivery. Okay. As per the above scenario, various dates are as under. Actual date of issue of invoice is September 18th. Due date for issuance of invoice is September 9th, as supply involves movement of goods, and date of receipt of payment is September 19th, earlier of entry in books of accounts and credit in books of accounts. And therefore, as per rule, the time of supply would be the earliest of the above dates, that is September 9th. Are we clear in this? Any doubts?
No, sir.
No,
So as soon as goods get removed from the factory, that will be the date on which the time of supply will be considered.
Sir, I had a doubt in the previous GTA things, Goods Transport Agency.
Yeah.
We have those two threshold limits of 1,500 per single carriage or 750 rupees for a single consignee. When does that get applied, sir?
That is when service, that is as a customer is giving service to anybody. And now if GST Transporters is giving, if you are hiring,
there's a cost of consignment.
if you are hiring the transporter facility from GST Transporters for shifting TV from your home to your friend's home, and he charges 700 rupees. So it is less than the limit. If he charges 5,000 rupees, it is above the limit. Now he need to pay GST. That is the kind of the end user. Here, the end user is the GTA itself, inter alia to Goods Transport Agency. Now, here if you see, North Star Trucking Limited has given on hire 11 trucks to Jaggi Transporters. Both are goods transport agency.
Okay.
So
So
this is a different
whenever
transaction.
it's supplied by a GTA, then we have to look at these conditions. Whenever the supply itself is between two GTAs, then it is exempt from.
Correct. It is to a GT. The service recipient is a GTA here. The limits that you are talking is when service is provided by GTA to a end user.
Okay, sir. So when it is received by GTA, it's always exempt.
Correct.
Okay, sir.
Are self-supplies taxable under GST? Interstate self-supplies such as stock transfers, branch transfers, or consignment sales shall be taxable under the IGST, even though such transactions may not involve the payment of consideration. However, intrastate self-supplies are not taxable, subject to not opting for registration as a business vertical. Now, if there are 3 registrations, now let us say I have registration of 3 business branch. One is in Chennai, one is in Hyderabad, one is in Bangalore. Okay. Now, if Bangalore sends goods to Chennai, then I need to collect GST because it is interstate supply. If Hyderabad sends goods to Bangalore, then it has to charge the GST, irrespective whether consideration is received or not. Now, let us say in Bangalore, I have 5 places, 5 godowns. Now, if I'm transferring goods from one godown to another godown, I need not pay any GST. But for the sake of convenience, if I have obtained 5 GST registrations inside Bangalore, then I need to pay tax from one GST to the other GST. So that is called self-supplies under GST. Discuss whether following transactions will be considered supply or not under GST laws. Can you quickly tell me? An individual buys a car for personal use and after a year sells it to a car dealer.
No, sir.
Okay. A dealer of air conditioner permanently transfers an air conditioner from a stock in trade for personal use as his residence.
I think no, sir. But if the air conditioner is charged to ITC, then it is supplied.
Provision of service or goods or by a club or association or society to its members. Whether a club is required to charge GST to its members for the services and goods provided by club or society.
Yes, I believe there is an amendment for this.
Let us see the answers. The first one is no, because the sale of old and used car by an individual is not in the course of furtherance of business and hence do not constitute supply as per section 7 or schedule 1 of the CGST rules. Now, the second one is where the AC is being transferred from the stock to his personal house. It is yes, because as per serial number 1 of schedule 1, permanent transfer or disposal of business assets where input tax credit has been availed on such assets shall constitute a supply under GST even where no consideration is involved. Third one is yes, where provision of facilities by a club, association, society, or any such body to its members shall be treated as supply because this includes the definition of business in section 217 of the CGST or SGST Act. Discuss whether the following transactions or activities will be treated as supply of goods or supply of service. Can you look into this?
Supply of services.
Yeah, transfer of right to use the goods is supply of goods or service in schedule 2. Works contract and catering is also a supply of service. Supply of software is also a supply of service.
Supply of service.
Goods supplied on hire purchase basis is also a transfer and supply of goods as per the transfer of goods, because on higher basis, because transferred on higher purchase, that means on a future date it will be transferred. So all these things are considered. If you want to quickly go through, I will give you a minute. You can refer the rules or the points that are given in the answer.
No, sir, we can continue.
Mr. Shah Mahoja, an unregistered famous author, received rupees 3 crore of consideration from Harshiv Publications located in Indore for supply of services by way of temporary transfer of a copyright under section 13(1)(a) of the Copyright Act 1957 relating to original literary work of his new book. He finished his work and made available the book to the publisher, but has yet not raised the invoice. Mr. Shah Mahoja is of the view that HSP, that is Harshiv Publications, is liable to pay tax under reverse charge on the services provided by him. Harshiv Publishers does not concur with this view and is not ready to deposit the tax under any circumstances. Examine whether the view of Mr. Shyam Ahuja is correct. Further, if the view of Mr. Shyam Ahuja is correct, what is the recourse available for Mr. Shyam Ahuja to comply with the requirements of GST law, as Harshiv Publishers has completely refused to deposit the tax?
Sir, because supply is being made to an unregistered person, it has to be paid in reverse charge mechanism. So his view is correct, but because they are not paying, he has to pay it by taking registration. Correct. Since that is not mandated by law, but that is also a way in which he can get it complied. View of Shyam Ahuja is correct. GST is payable under reverse charge in case of supply of service by an author by way of transfer or permitting the use of enjoyment of a copyright covered under Section 13(1)(a) of the Copyright Act relating to original literary work to publisher located in taxable territory in terms of reverse charge notification 13/2017. Therefore, in the given case, person liable to pay tax is the publisher, Harshiv Publishers. However, since HSP has completely refused to deposit the tax, pay the tax on the given transaction, Mr. Shyam Ahuja has an option to pay the tax under forward charge on the same. For the purpose, he needs to fulfill the following conditions. Since he is unregistered, he has to take the registration first, and then he need to file a declaration in the prescribed form that he exercised the option to pay CGST on the said service under forward charge in accordance with Section 9(1) of the CGST Act, and to comply with all the provisions as they apply to a person liable for paying the tax in relation to the supply of any service which shall not withdraw the said option within a period of 1 year. He has to make a declaration on the invoice which he would issue to HSP on the prescribed form that he has paid the tax on the forward charge, and accordingly HSP is not required to pay. So what is National Anti-Profiteering Authority? This is one of the authority which is still not effectively functioning, but you can get a theoretical question on this. I'll quickly give you a minute to just go through. If you have any doubts, you can let me know. I can explain. So is there any recent case on which National Anti-Profiteering Authority has given any order?
I have to look into it. I don't think it is still effectively functioning or it has come into force, but they are rigorously waiting to implement this. That is what I understand, but I'll have to check for this.
Okay, sir.
You can proceed further, sir.
All of you are finished?
Yes, sir.
Yes, sir.
Mohan Enterprises has made supplies of rupees 5,50,000 to B Enterprises. Municipal authorities of Jaipur on such supplies levied the tax at 10% of rupees 55,000. CGST and SGST chargeable on supply was rupees 66,000. Packing charges not included in the price of rupees 5,50,000 amounted to rupees 15,000. Subsidy of rupees 25,000 was received from an NGO on the sale of such goods, and the price of rupees 5,50,000 is after taking into account the amount of subsidy so received. Discount offered is at 1%, which was mentioned on the invoice. Determine the value of supply. So can you quickly compute? You want any assistance? If it is very confusing, you let me know. We'll solve together.
Sir, can you revise the pricing provision once?
Price?
What all they are supposed to consider in price?
Yeah, we'll revise that, not an issue. The value of supply, that is the invoice value, right? Everything should be considered.
Yes, sir.
Whatever is supply as per the section 7 and schedule 1, where it is not included, all the other aspects has to be considered. So let's go through it. You will get here. The trade discount, see if you have the notes here, CGST and SGST is not included in the determination of the value of supply, rather taxed post determination on the same. Subsidy, since received from a non-governmental body, is added back to determine the value of supply. Now, if it is received from a governmental body only, it is available as not to be included. If it is a non-governmental body, it will form part of the value. And discount on base price is an exclusion. Now, if you have given discount on the base price at the time of in the invoice, then it is exempt. Otherwise, it is taxable. So on 5,50,000, tax charged by municipal authorities is 55,000. That is also my municipal value. Packing charges 15,000. Subsidy from NGO 25,000. All put together, it will become 95. Discount is exclusion 5,500 on 5,50,000. So totally 6,39,500 will become my point of value for supply for collecting my GST. Any doubts on this?
No, sir.
No, sir.
No, sir.
Who is a pure agent in GST? This is again a theoretical question. I think we also got an example to see in terms of company secretary paying 3,000 rupees on behalf of the client and then charging the same on pure agent basis, where it does not include any additional profit element, then it is considered as pure agent basis. So that is point as the last point. Receives only the actual amount incurred to procure the goods or service. In addition to the amount received or supply, he provides on his own account. So there are examples on pure agent basis. I'll quickly stop here. Examples of reimbursement by pure agent. Mr. X purchases furniture from Mr. Y for rupees 1,50,000 and requests Mr. Y to deliver the same to his office. Mr. Y, who has a retail furniture shop, does not himself undertake services of delivery of furniture. On special request of Mr. X, Mr. Y agrees to deliver the furniture to Mr. X office by hiring a transporter. The actual charges paid to the transporter rupees 10,000 would be reimbursed by Mr. X to Mr. Y. In the above example, the arrangement between Mr. X and Mr. Y is only for sale of furniture, that is rupees 1,50,000. Okay. Now, in this case, the amount paid by Mr. Y to the transporter is on behalf of Mr. X, which would be reimbursed on actual basis, and this does not form part of the contract. Therefore, in the above mentioned example, the sale of furniture by Mr. Y to Mr. X is on principal to principal basis. The expenses for transportation for transport of furniture incurred by Mr. Y on behalf of X and reimbursed by X would be considered as pure agent service. However, if the agreement between X and Y was for sale as well as delivery of furniture rupees 1,60,000, in such a case, Y would be availing the service of the transportation for his own interest, and therefore he would be not considered as pure agent in this case. For the purpose of determination of pure agent service, it is pertinent to observe that the person who provides any service as a pure agent should only be reimbursed for actual amount which was incurred as an expense. Therefore, in the above mentioned example, if the amount paid by Mr. X to Mr. Y as reimbursement for transport of furniture is more than 10,000, then this would not be considered as a case of pure agent. In such a case, the amount paid would be included in the sale price of the furniture. Is that clear?
Yes, sir.
Yes, sir.
All self-explanatory. GST, I think, no much complication. Anyways, Mr. Gogoi received Vastu consultancy service for her residence located at Sector 62, Noida, from her daughter, Miss Sia of Sydney, Australia. Further, Mrs. Gogoi did not pay any consideration for the said service. So this is import of service, basically. Examine whether the activity of import of service would amount to supply under Section 7 of the CGST Act.
No, sir, because it's for personal use, I think.
Correct, not for furtherance of business. Section 7 of Central Goods and Service Act, read with Schedule 1, provides that import of service by a taxable person from a related person located outside India without consideration is treated as supply if it is provided in the course of furtherance of business. In the given case, import of service without consideration by Mrs. Gogoi from her daughter, Miss Sia, being member of the same family as a related person, will not be treated as supply as it is not in the course of furtherance of business. Next comes in terms of operations of slump sale. Mrs. Ridhima had a factory situated in Delhi, which he transferred to Uttar Pradesh and closed all operations in Delhi. Whether it will constitute slum sale and whether it is liable to tax under GST. Section 7 says that anything for furtherance of sale, whether it is sale, transfer, barter, exchange, lease, rental, license, disposal made or agreed to be made for consideration by a person for furtherance of business. Entry number 4C of the Schedule 2 refers to the transfer of business assets, which read as under transfer of business assets, where any person ceases to be a taxable person. Any goods forming part of the asset of any business carried on by him shall be deemed to be supplied by him in the course of furtherance of business immediately before he ceases to be a taxable person, unless the business is transferred as a going concern to another person, or the person is carried on by the business is carried on by a personal representative who is deemed to be a taxable person. At the end of the day, they want to collect tax on either way. Either it is deemed taxable person or by deeming it as a transfer as a supply. This clarifies that the transfer of business as a going concern shall not be treated as supply of goods. Further, serial number 2 of notification 12 dated June 28, 2000 provides that exemption for service by way of transfer of going concern as a whole or an independent part thereof as nil rated. Hence, the transaction of slum sale is not liable to GST, because in slum sale it is transferred as a going concern and it will be continued by the next person. Is that clear? Any doubts on supply?
No,
So
sir.
these are the questions these are the types of the questions that could come in your exams, and most of them are coming in this fashion, and you need to present your answer in this fashion.
Sir, can we do some more sums in supply?
We can do, if you have any further, if you have any questions where you have the concern, we can do it. Not an issue. Where are you facing the challenge exactly in supply?
Sir, in valuation, can we do some sums?
Yeah, we can do. But before that, what is the kind of challenge you're facing? I want to understand.
Like, because there are various types of valuation of supply in that different types of service we need to value. Like, for example, foreign currency, it has to be transferred. Those type of sums, different things that we can.
But they're not asking that complicated in terms of foreign currency. Anyways, 1 second. Let me open the material. Others, any other doubts?
No, sir.
Sir, audit under GST is eliminated. Am I right?
Audit under GST is
Completely eliminated.
not eliminated. It continues to be there, but certification from external party is not required. Filing of GSTR 9C still exists.
Okay.
Sir, we can go to the next chapter if that's the only valuation we can do it at once.
Yeah. I'll just try to see if the value of supply where you're talking, we'll see if I can give you a definition so that it is clear for you. Because it has a lot of different types of valuation in terms of air travel agents or life insurance business, second-hand goods, and in case of food, in case of other taxable services. So you need to read in those concepts. So basically there are around 8 to 10 pages of that separate rules in the material that needs to be focused. If you're focused on that, then any kind of problem you will be able to solve.
Yes, sir. I think I will just revise.
Yeah. So the next chapter that we'll be going to is procedural compliance under GST. Yeah. So procedural compliance, we need to be aware of registration. We need to be aware of tax invoice, debit note, credit note, accounts, records, electronic e-way bill, then payment of tax, returns, and forms, refund, and compliance rating. So write a short note on suspension of GST registration based on return comparison. Okay. Now, when can GST registration be suspended? Based on return comparison. Now, what does the standard operating procedure say? There is something called SOPs given to the GST officers. Based on that standard operating procedures, they will be evaluating the situation of the taxpayer, and accordingly they will take actions if it is not in accordance with the SOPs provided. The GST officers will immediately suspend registration of taxpayers whose sales returns or GSTR1 forms shows significant differences or anomalies from the return filed by their supplier forms. Supplier form shows significant differences on anomalies from the return filed by their suppliers. A move aimed at curbing tax evasion and safeguarding revenues. The Central Board of Indirect Tax and Customs has issued a standard operating procedure for suspension of registration of a person on observance of such discrepancies or anomalies which indicate the violation of GST Act. What is that rule? It says, Subrule 2A of Rule 21 of the CGST rules provides for immediate suspension of registration of a person as a measure of safeguard and safeguard the interest of the revenue on observance of such discrepancies or anomalies which indicate violation, and rules made thereunder, and that continuation of such registration poses an immediate threat to the revenue. The registration of specified taxpayer shall be suspended, and system-generated intimation for suspension and notice for cancellation of registration under Form GST Reg 31 containing the reason of suspension shall be sent to such taxpayers at their registered email ID. Rule 21A of the Central and Goods Tax deals with provisions of governing of suspension of GST registrations. It has been inserted into CGST rules 2019. With the introduction of this rule, a taxpayer who has applied for cancellation of GST registration will not be required to comply with GST return filing provision during the suspension period. So this is the kind of thing. They will be given opportunity also. Some 30 days time will be given. So here it is there. Yeah, in the second para, that the jurisdictional tax would be required to furnish reply to the jurisdictional tax officer within 30 days from the receipt of such notice. They will first give a notice, show cause as to why the cancellation should not be done and what is the basis on which the cancellation should not be done. And accordingly, they will take it further to not to cancel or cancel if the reply is not clarity is not given as to why it should not be cancelled. Okay, now this is a practical question that had come in one of the examination. Zep, a registered supplier, runs a general store in Ludhiana, Punjab. Some of the goods sold by him are exempt, whereas some are taxable. You are required to advise him on the following issues. Whether Zep is required to issue a tax invoice in all cases, even if he is selling the goods to the end consumers. Now, this is with respect to invoicing. So he is dealing in both taxable goods and exempt goods. Now, the question is whether he is required to issue tax invoice in all cases, even if he is selling the goods to the end consumers. That means he is not selling it to further customer. It is not a B2B sales, it is a B2C sales. not a business to business transaction. It is business to customer transaction. Whether he is required to raise invoice on B2C transaction also? Yes or no? Yes, are you all there? Can I have the active participation from the people who are present? Quickly. So he is not required to issue tax invoices in all cases. As per section 31 of the 1 of the CGST Act, every registered person supplying taxable goods is required to issue a tax invoice. Section 31(3)(c) says, stipulates that every registered person supplying exempted goods is required to issue bill of supply instead of tax invoice. So in case of exempt supplies, you need to give bill of supply and not tax invoice. Further, Rule 46A of the CGST rules 2017 provides that a registered person supplying taxable as well as exempted goods or services or both to an unregistered person may issue single invoice cum bill of supply for all such supplies. However, as per section 31(3)(b) of the CGST Act, read with Rule 46 of the CGST Act, a registered person may not issue a tax invoice if the value of goods supplied is less than rupees 200. The recipient is unregistered and recipient does not require such invoice. Instead, such registered person shall issue a consolidated tax invoice for such supplies at the close of each day in respect of all such supplies. So he can has an option to raise a consolidated supply. If customer does not need it, he need not issue it. And if it is less than 200, he need not issue it. So you need to write these reasons. Registered, whether the recipient is unregistered or the value is less than 200, or if the recipient does not need the invoice, he need not raise a tax invoice. Is that clear?
Yes, sir.
Okay. So we'll finish these two more and take a break, and then we'll come back and continue after the lunch break. ZEB sells some exempted as well as taxable goods valuing rupees 5,000 to a school student. Is he mandatorily required to issue two separate GST documents? So we have already seen this. He can issue invoice cum bill of supply, or he need to issue separately. Okay. As per Rule 46A, where the registered person is supplying taxable as well as exempted goods or both to an unregistered person, a single invoice cum bill of supply may be issued only in case of unregistered. Otherwise, it is not possible. Thus, therefore, he is no need to issue tax invoice and a bill of supply separately to the school student in respect of supply of taxable and exempted goods, respectively. Last one. ZEB wishes to know whether it is necessary to show tax amount separately in the tax invoice issued to the customers. Advise accordingly. One of the component of the tax invoice is that tax amount needs to be shown separately. As per section 33 of the CGST Act, read with Rule 46CM, where any supply is made for consideration, every person who is liable to pay tax for such supply shall prominently indicate in all documents relating to assessment, tax invoice, and other like documents, the amount of tax which shall form part of the price at which the supply is made. Hence, ZEB is required to show the tax amount separately in the tax invoice issued to the customers. Is that clear?
Yes, sir.
Yes, sir.
Okay. So we'll have half an hour break and come back with the continuation of this chapter, and then we'll proceed to the inspection, survey, GST audit, so all these things, and then we'll go to customs, and then we'll revise the other smaller chapters.
Okay, sir.
Okay, thank you. We'll resume back after half an hour.
Okay, thank you, sir.
Hello.
Welcome back. So we'll continue with the next question.
Okay, sir.
Is it necessary for foreign embassies to get registration under section under CGST Act 2017? So we need to understand whether who all are required to get the registration mandatorily and whether is it important. So there is something called as they need to get a unique number identification. Let us see, all UN bodies, consulate or embassy or foreign countries and any other class of persons. So notified would be required to obtain a unique identification number from the CGST portal. With this unique identification number will be needed for claiming refund of taxes paid by them on notified supply of goods or services or received by them. So basically, foreign embassy or foreign consulates are not required to take any GST registration, but they need to take the unique identification number required for claiming the refund that they have, for claiming the refund of taxes that they have paid. Further, it is apt to state here that every person required to be granted a unique identification number in accordance with section 25/9 of the CGST Act may submit an application electronically. These are all procedural. They need to give this an application under section form GST REG 13, and they will get a approval or a certificate of unique identification number in GST REG 06. Okay, within 3 working days after the submission. So that is all about the requirement for thing. What will be the value of supply of goods or service or both between distinct or related persons or through an agent? Okay, what will be the value of supply when it is between the distinct person or a related person other than through an agent? So here we need to see when transactions are between related parties and transactions are done through a open market. The value of supply between distinct person or related person other than through an agent shall be determined in the following sequential manner. First thing, I'll have to see the open market value of such supply and value of supply of goods or service of like kind and quality or value as per Rule 30 or Rule 31 in that order. So we'll have to see the Rule 30, Rule 31 in that order. What is the Rule 30? Rule 30 gives us that value equivalent to 110% of the cost of the production or manufacture or cost of the acquisition of such goods or the cost of such provision. So ideally what they say, minimum 10% should be the markup. Minimum 10% should be the markup. Rule 31 provides that where the value of supply of goods or service or both cannot be determined under Rule 27 to 30, the same shall be determined using reasonable means consistent with the principles and general provisions of Section 15 of the provisions of this chapter. Somebody joining with the name iPhone, can I have the name be renamed? And you know who is joined with the name iPhone? There is no response, then I'll have to remove from the meeting. Okay, let us continue. Further, where the goods are intended for further supply as such by the recipient, the value shall at the option of the supplier be an amount equivalent to 90% of the price charged for the supply of goods. So this is all about the where you need to remember that it should be minimum 10%, 110%, or it should go between in terms of the section 15, where the provisions of this chapter are dealt with. Casual and non-resident taxable person due date will go to some complicated provisions. Yeah, this is important. Most of the times you get this. Mr. H is an exporter. He exports machinery out of India and pays 28% of IGST. He wants to know the procedure for claim on the grant of refund of IGST paid on goods exported out of India. His accountant has advised that to export machinery without payment of IGST and claim refund of unutilized input tax credit. Is it possible? If yes, how? So here, any thought process, anything that you are already aware of these things?
I'm not so well with the refund process, sir, so I don't know the methodology.
Okay. So there are two aspects. One, in export, I'll have to pay the tax and then claim the refund, or I'll have to obtain a letter of undertaking telling that I am not, I am doing only export of goods, so I am not required to claim any payment. So I'll have to make the payment. Without making payment, I can do the export. When I'm doing only exports, and I am entitled for refund, what happens to my input credit? Input credit is also eligible for refund. So let us see export on payment of tax. In terms of Rule 96, the CGST rules, shipping bill filed by an exporter of goods shall be deemed to be an application for refund of IGST tax paid on the goods exported out of India. When person in charge of the conveyance carrying the export goods duly files an export manifest or an export report covering number and date of shipping bills or bills of export, and the applicant has furnished a valid return in Form GSTR 3 or Form GSTR 3B as the case may be. Now, GSTR 3B has to be filed and the shipping bill will act as a application for refund. In this regard, the details of relevant export invoices in respect of export of goods contained in Form GSTR 1 are required to be transmitted electronically by common portal to the system designated by customs. And the said systems will revert the confirmation of export of goods. Upon receipt of the information regarding the furnishing of a valid 3 or 3B, the custom system shall process the claim for refund, and an amount equal to IGST paid in respect of each shipping bill or bill of export shall be electronically credited to the bank account of the applicant mentioned in his registration particulars and as intimated to the custom authorities. So it is an automatic process. Once the GSTR 1 is filed, it automatically transmits to custom portal. Custom portal will validate based on the shipping bill furnished by the shipper. And then it comes back to revalidate with the GSTR 3B, and then it will be paid back to the account of the exporter. In respect of claiming refund of integrated tax paid on export of goods or services should not have received the supplies on which the benefit of notification. So it should not be under benefit notification. And export without payment of tax on LUT. That's what I said. There is something called as LUT basis, letter of undertaking. So I take a letter of undertaking telling that I'm only doing export, so I will not make the payment of tax, and I will make the export with a zero rated supply. So as per Rule 96A of CGST rules, any registered person availing the option to make a zero rated supply of goods or service without payment of integrated tax shall furnish a bond or letter of undertaking in form GST RFD 11 prior to the execution of such supply. Now, if I have taken this letter of undertaking prior to the supply, then it is permitted to make the export without payment of tax. Otherwise, I need to make the payment and then go for claiming the refund. So all these big procedures are there. You need not write such a big procedure, not required. And all the conditions are given as to how and when it can be claimed as a refund. Going further, what are deemed exports? Are deemed exports eligible for refund under GST? If yes, who can file an application for refund in case of deemed export? Very good question. I think this is also being asked commonly in the examination. As per Section 2, subsection 39 of the CGST Act, deemed exports means such supplies of goods as may be notified under Section 147 of the CGST Act. What does Section 147 says? GAR states that government may, on recommendation of the council, notify certain supplies of goods as deemed exports. That means I have not actually exported, but it is considered as deemed export. Where goods supplied do not leave India and payment for such supplies is received either in Indian rupees or in convertible foreign exchange if such goods are manufactured in India. That means what happens certain times, the goods are manufactured in India and sold to 100% SEZ or export oriented units, then that is considered as it is actually exported. Okay. Hereby notify the supply of goods listed. Supply of goods by a registered person against advance authorization. That means supply of goods by a registered person against an advance authorization, or supply of capital goods by a registered person against export promotion capital goods authorization. Supply of goods by registered person to export oriented unit. This is what I was telling. Supply of goods by bank or public sector undertaking specified in notification number 50/2017 against advance authorization. These are all called as deemed exports. Once it is deemed exports, they are also eligible for refund, as the word refund is defined in explanation to section 54 of the CGST Act, explicitly include refund of tax and interest paid on supply of goods regarded as deemed exports. Again, the application and all procedures will remain same. They'll have to make an application and claim the refund to the bank account. Now, what is the purpose of compliance rating? This is an important question again. Now, whoever is filing the returns on timely manner, all of this will be considered as compliance rating. And the GST taxes are paid on time without any delay and interest. All of this, there are certain parameters: timely filing, timely payment, and not excluding any of the returns. As per section 149 of the CGST Act, every registered person shall be assigned a compliance rating based on the record of compliance in respect of specified parameters. Such ratings shall also be placed in the public domain. A prospective client will be able to see the compliance rating of the suppliers and take a decision as to whether to deal with a particular supplier or not. This will create healthy competition amongst taxable persons. So this rating is just to give who is doing good, who is more compliant, and who is well positioned in terms of the market competition. That is only the concept of compliance rating. What are the situations under which e-way bill is not required? Now, the first thing, the simple limit is if it is less than 50,000, it is not required. And if it is for within the state and within for certain categories of items, it is not required. Let us see the list of categories of items for which it is not required. All GST registered business owners are bound to create e-way bill when they transport goods from one place to another if the consignment value exceeds 50,000. However, there are several situations where e-way bill is not required, and those situations are listed below. As per Rule 138, Clause 14 of CGST rules, no e-way bill is required to be generated under following situation. E-way bill is not required in following cases. That is, be generated when below mentioned goods are being transported. That is LPG, kerosene oil, postal baggage, jewelry, goldsmith and silver items, used personal and household effects, coral unworked or worked coral. In case of transportation of goods from custom ports, airport, air cargo complex, and land customs station into to an inland container depot or a container freight station for clearance by customs. Say, for example, goods have come to customs port. From customs port, they are transferring to inland container depot, ICDs. Now, in the ICD, it is going for freight clearance or customs clearance. So, since the custom clearance is happening in the ICD, they need not do any e-way bill for movement of goods from port to inland container freight system. When goods are being transported by non-motorized conveyance, e-way bill generation is not required. What is non-motorized conveyance? That means a ship which is running based on the wind force energy, or it is running through a motor energy without electric. Okay, so those kinds of things, e-way bill is not required.
Rickshaw also can be included.
Which one?
Rickshaw. Normally, like with cycling part will be there.
Correct. Like in case of horses, all of that transportation, bullock cart, all of that is considered as non.
Yes, sir.
When following goods are transported, the e-way bill is not required to be generated. Alcoholic liquor for human consumption, petroleum crude,
exempted goods.
Exempted goods. That is, which is not. All of these are kept outside the purview of GST. Basically,
GST. Yes,
aviation, turbine fuel, natural gas, motor spirit, all of this.
Yes.
Then comes e-way bill is not required to be generated when the goods are being transported under customs bond from an inland container depot or container freight station. to a customs port, airport, air cargo complex, and land customs station, or from one customs station to another customs station. So anything from airport to customs or clearing agent or clearing house, not required. Where goods are being transported are transit cargo from or to Nepal or Bhutan, it is not required. Where the goods are being transported are exempt from tax under various notifications, it is not required. When central government, state government, or a local authority acting as a consignor undertakes transportation of goods by rail. So anything related to central government transactions or state government transactions, it is not required. When goods movement has been caused by defense formation, it is not required. No e-way is required in case of transport of empty cargo containers. In case of goods are being transported for weighment purpose and the distance is not more than 20 kilometers from the place of the business of the consignor to the weight bridge or vice versa, e-way generation is not required. However, the movement of goods must be accompanied by a delivery challan. When goods specified in schedule appended to notification number 2 or 2017 is being transported other than de-oiled cake, and then in such e-way bill, it is not required to be generated. So most of the things you can keep remembering this 20 kilometers criteria and the exempted goods criteria, government criteria, and this from customs to inland container depots or freight systems. So these are the air cargo complex. These are the important things where e-way bill are not required for you to keep a tab on remembering. Is that clear?
Yes, sir.
Okay, so we'll move to the next thing: assessment, audit, scrutiny, demand and recovery, advance ruling, appeals and revisions. This is your chapter number 5. Okay.
Sir,
Yeah.
so is it possible that you give the overview of the assessment, scrutiny, and then go for this question paper? Because it will be so hard for me to.
Yeah. So the mechanism in each of the law, either it is income tax or GST, there is something called as self-assessment. What is self-assessment? When the self-assessment means I declare suo motu myself all the transactions to the tax authorities in the form of returns. Either it is GST returns or income tax returns. Now, in case of GST, there is something called as GSTR1, GSTR3, and other returns, GSTR9 annual returns, all of that. First stage of assessment is self-assessment, that I need to do an assessment on myself and declare the information in the required form that is prescribed. Once this is reviewed and once this is permitted for verification, the tax authorities can revisit the methodology of computation or the sufficient audit documentation, whether it is available or not. He can initiate the audit. Okay. Once the audit is initiated, the documentations has to be provided to the GST officers. Now, if I tell my turnover for the month of November is 1 crore 75 lakhs, how have I arrived at this 1 crore 75 lakhs? Whether my sales invoice are matching to 1 crore 75 lakhs, whether my books of accounts is having 1 crore 75 lakhs, he can ask for sales ledger, he can ask for copies of invoices, he can ask for all the monies realized or not. He can ask for a bank statement. If in my bank statement, if my monies received is more than 1.75 crores, he can have a question. So why not you have not shown the other amounts which are received in excess of 1 crore 75 lakhs as sales in your return, but only 1 crore 75 lakhs. So these kind of questions can be done. Audit and scrutiny will be done. And then if there is any mismatch or if there is any amount which is not considered appropriately during the self-assessment, then it will be considered as adjustment and extent of non-compliance. So that is called as demand. And then further, this amount will go, this amount needs to be paid by the taxpayer within a certain time limit of 30 days. If it is not paid, then he can go for an appeal mechanism. So if he feels that the view taken by the officers or the GST office is not very clear, or he has not understood or he has not reviewed the documents provided are clear, then he can go for an appeal before the appellate authorities. Now, during the appellate authorities also, if they get a favorable order, it is good that he will not be required to pay the tax. Otherwise, at the end of the day, he need to pay the tax. If the appeal mechanism is not preferred, if I have not filed an appeal, then it is as good as that I have accepted the demand. Now, if I've accepted the demand and if I have not paid the demand, then they can initiate the recovery proceedings. Recovery proceedings is nothing but they have our bank account details. They can attach or they can give an instruction to the banker to block the account and take the money in the account as appropriation against the demand, and they will collect or they will give an instruction to transfer the money from the taxpayer's account to the government account without any permission, and there is no requirement for any permission of the taxpayer. So that is the recovery proceedings that they have. And advance ruling and revision. I have spoken about appeals, but advance ruling is one thing. Like we discussed about advance pricing agreement and transfer pricing. Similarly, there is a GST, there is something called as advance ruling. If there is a confusion amongst a particular item of taxability or the tax treatment or a tax rate understanding, then I need to approach GST Advance Ruling Authority and give the summary of the clarifications that are required and summary of the transaction that I am intending to take forward, and obtain a confirmation as to what is the correct tax rate and what is the correct liability that needs to be discharged in terms of the proposed transaction. Now, this is called advance ruling, similar to advance pricing agreement. In case of advance ruling, the liability is already construed and liability is already defined by the tax authority itself. So in future, there is no scrutiny, audit, and there is nothing kind of any investigation that can happen. And revision, any order that is already given by the GST authorities, it can be revised based on a certain condition, that if there is any revisit that they need to do. If a lower GST authorities or lower officers of the GST have already passed an order, and higher authorities feel that if there is some mistake or if there is some error or omission in the order passed, then they can revise the order by revisiting the entire proceedings. So this is overall approach of what happens in an assessment, audit, and scrutiny. It is just a next level of scrutiny or next level of verification of what has been done by the taxpayer is in correct sense, or is it rightly done by the taxpayer or not. So that is the importance of assessment, audit, and scrutiny. Most of the times what happens, there is a interest required to be paid in case of delay payment of GST, and most of them do not pay that. Now there will be a scrutiny done by the GST office, and they send a notice stating that you have filed returns delayedly, and so much is the delay and so much is the interest liability. So these kind of notices keep coming in, demands keep coming in, and recoveries need to happen. Input tax credit claimed, which is higher than the books of accounts, then again they will give a telling that input tax credit claimed in excess, so you need to pay the tax again on that amount. So these kind of revisions keep happening, or these kind of verifications keep happening in day-to-day basis for all the taxpayers wherever the system sees that there is some inconsistency. So these are all automated system triggers where they see that, okay, last 10 months the sales was around 1 crore, but this month it has come down to 40 lakhs. So from 1 crore it has come to 40 lakhs. The system will give an immediate trigger to state that something is not correct here. Regularly, the 1 crore sales was coming, but in this case, it is reduced to 40 lakhs. So we need to understand, or they will issue a notice to understand why there is a reduction in the sales. So these kind of verifications keep on happening, and this is the entire process of the powers that are available with the GST authorities to review or verify and authorize any kind of checking that is permissible under the law. So hope this background is sufficient and helpful.
Yes, sir. Yes, sir, it is helpful, sir. Sir, and also I want a difference between a summary assessment and scrutiny assessment. What is the difference, basic difference? I often get confused between these two. So
summary assessment is just the collation of information that is already available, and this is done by a system basically. Okay. Scrutiny assessment is I verify and do the assessment. The tax officer will verify, call for the information, call for the books of accounts, call for the supporting documents. The officer will scrutinize and then conclude the assessment. Summary assessment is whatever information that is already available in the form of GSTR1, GSTR3B, or other information that is available online. Based on the information already in his possession, he will do an assessment that is called summary assessment. Basically, initial assessment is called a summary assessment. Post detailed verification, it is called a scrutiny assessment in simple terms.
Okay, sir. Okay, sir. Thank you, sir.
Who is the person responsible to make assessment of taxes payable under the CGST Act 2017? So every taxpayer or every person who is a taxpayer is required to do the self-assessment. That is called as the first step of assessment. Here, what we call it as who is the person? Every person registered under the CGST Act 2017 shall himself assess the tax payable by him for a tax period, and after such assessment, he shall file the return required under Section 39 of the CGST Act. So this is called self-assessment, will be the norm under GST. Further, CGST Act 2000, as per Section 39, the taxable person other than IST, TCS and TDS or non-resident and composition levy tax person shall for every calendar month or part thereof furnish GSTR3 returns electronically of inward and outward supplies of goods or services or both, input tax credit availed, tax payable, tax paid and such other particulars as prescribed under GSTR3. Which is a return format on or before 20th day of the month succeeding the tax period. So this is all procedural that we know. This is the entire thing is called as assessment. The self-assessment is a process whereby a person first assesses tax payable by him, pays the tax, and then files the return, furnishing the details of how he has arrived at the tax payable by him. The assessment as made by the registered person would be treated as final. So that is this is the first level of assessment, basically self-assessment, and that is considered as final, subject to verification and review. Understand under what circumstances can provisional assessment be done. So what is called as provisional assessment? As a taxpayer has to pay a tax on self-assessment basis, a request for paying tax on provisional basis has to come from the taxpayer, which will then have to be permitted by the proper officer. That means today I am telling the transaction that I am entering today, I am not sure what will be the final value. So I am willing to pay the tax, but I don't know on what amount I need to pay the tax. So I need to determine the value on that transaction based on further procedures to be performed. As of today, I don't have that conclusive procedures to be concluded. So I know roughly this is the amount that I need to include, but I don't know the accurate amount. In that cases, I make an application to the proper officer stating that I need to pay tax on the provisional basis, and that is called as provisional assessment. This is governed by Section 60 of the CGST Act 2017 and Rule 98 of the CGST rules. Tax can be paid on provisional basis only after the proper officer has permitted it through an order passed by him. For this purpose, the taxable person has to make a written request to the proper officer, giving reasons for payment of tax on provisional basis. Such a request can be made by giving reasons for payment by the taxable person only in such cases where he is unable to determine the value of goods or service to be supplied by him, or he is not able to determine the tax rate applicable to the goods or services to be supplied by him. In such cases, the taxable person has to execute a bond in the prescribed form and with such surety or security as the proper officer may deem fit. Now he can take some collateral undertaking or understanding. Okay, so that is the provisional assessment. Now coming to the summary assessment, which we discussed some time back, let us try to see what technically summary assessment under section has defined. Summary assessment is stated under Section 64 of the CGST Act 2017. The authorized officer is required to obtain prior permission of additional commissioner or joint commissioner to take this assessment, because to protect the interest of the revenue, a GST officer can proceed to assess the tax liability of a person showing a tax liability with any evidence. The officer can also issue an assessment order ID to the order ID. He has proof that delay in assessment can adversely affect the interest of the revenue. So he can take the permission, he need to take the permission and then proceed with the order. What happens next? The proper officer may, on any evidence showing a tax liability of a person coming to his notice, with the previous permission of the additional commissioner or joint commissioner, proceed to assess the tax liability of such person to protect the interest of the revenue and issue an assessment order. If he has sufficient grounds to believe that any delay in doing so may adversely affect the interest of revenue, provided that where the taxable person to whom the liability pertains is not ascertainable and such liability pertains to supply of goods the person in charge of such goods shall be deemed to be taxable. Now, for example, he feels that the person is leaving India in next 5 days. Now, if he does not do this assessment, he feels that he loses the entire GST income. So today he go ahead, he takes the permission and he passes the order and he completes the order. He does not have time to do the assessment, scrutiny. So he is going for a summary assessment. So the order of assessment shall be issued in form A7060 and a summary of the order shall be uploaded electronically in form number GST DRC 07. When an application made by the taxable person within 30 days from the date of receipt of the order passed under subsection 1 or on his own motion, if the additional commissioner or joint commissioner consider that there is such order is erroneous, he may withdraw such order or follow the procedure laid down in section 73 and 74. That means he can, once the order is passed, if he feels that if there is something mistake or if it was done erroneously, then they can take it back. Is that clear? Summary assessment now?
Yes, sir. So is it essential to write all those form numbers and all for this, for any 4 mark question or something? Do we have to write all those form numbers?
Wherever you remember, if you write, it will give the weightage. If you don't write also, it is fine.
Oh, okay, sir.
So we'll see further what is the audit under GST. Explain audit under GST. So what is audit under GST? So according to the section 13(2) of the CGST Act, the term audit refers to the examination of, that means audit means I am doing an audit. So that means he can examine the records, returns, and other documents kept or filed by the registered person under the Act, or examine any rules or guidelines under GST or any other state law for the time being in force. This examination is undertaken to check the correctness of the turnover mentioned, taxes paid, refund claimed, and ITC availed. Further, this scrutiny is undertaken to evaluate the taxpayer's compliance with the provision of the Act. Very simple. Audit means verification. So I need to verify the correctness of the turnover declared, taxes paid, or refund claimed, or ITC availed. These are the 4 components that are critical in money. Okay, whether GST is paid properly, whether GST refund is claimed properly, or any input tax credit is paid, taken properly or not. This will be verified in accordance with the books of accounts, documents kept in accordance with the rules and regulations, and complied in accordance with the CGST and SGST or IGST rules. So this is called as audit under section 13 subsection 2. Which are the applicable provisions for the purpose of recovery of tax, short paid or not paid, or amount erroneously refunded, or input tax credit wrongly availed or utilized under CGST Act? Section 73 and Section 74 of the CGST Act deals with the recovery of tax short paid or not paid, or amount erroneously refunded, or input tax credit wrongly availed or utilized. Okay, so in this particular section, that is 73, deals with the cases where there is no invocation of fraud or suppression or misstatement, and Section 74 deals with cases where the provisions related to fraud, suppression, and misstatement are invoked. So they've asked only which provision. They have given the answer as 73 and 74. 73 in simple cases where there is no fraud or misstatement. 74 in cases of fraud and suppression and misstatement. What are the modes of recovery of tax available to the proper officer under GST laws? I told they can attach the bank and do things, and if they can also seize the goods, they can visit the factory and they can dispose of the goods, everything, and recover the taxes. Section 79 of the CGST Act 2017 deals with the modes of recovery of dues. In terms of the said provision, the proper officer may recover the dues in the following manner. Deduction of the dues from the amount owned by the tax authorities payable to such person. If there is any refund to be provided by government to taxpayer, it will be adjusted in that. Recovery by way of detaining and selling any goods belonging to such person. That means they can seize the goods, sell the goods, and recover the tax. Recover from other person from money.
Sorry to interrupt you, sir.
Yeah.
This is same like we have in customs also. So we are through with this, I believe.
Yes. All of you are clear, or you want this?
In customs also we have the similar one.
Correct. So basically it is any kind of things, they can sell and they can take the money. And if it is an immovable property, they can sell and take. If it is holding
Yes,
money
sir.
in an account, they can take the entire money from the account and they will be able to appropriate the thing.
And the main motto will be to recollect the dues, whatever they have.
Correct. The proceedings under CGST Act 2017 before the authorities, including the appellate tribunal, can be attended by the authorized representative. Explain who can act as an authorized representative under the Act. Now here, who can represent the taxpayer? If the taxpayer can go himself, it is good. If it is not going, if the taxpayer is not going by himself, you need to appoint an authorized representative who can be the authorized representative. So as per section 1162 of the CGST Act, the expression authorized representative shall mean a person authorized by person referred to in section 116(1). That is, appear on his behalf being a relative or a regular employee. Okay, is a relative or a regular employee, or an advocate who is entitled to practice in any court in India and who has not been debarred from practicing before any court in India, or any chartered accountant, a cost accountant, or a company secretary who holds a certificate of practice and who has not been debarred from practice, or a retired officer of commercial tax department and of any state government or union territory of the board, or any person who has been authorized to act as goods and service tax practitioner on behalf of the concerned person. So 5 things you need to remember. You need to remember relative or employee. So these are internal people. Then you have advocate or the other professionals like CA, CWA, or CS. Okay, so that is in the 3rd category. And the 4th category is retired commercial tax officers, and 5th category will be the authorized person as GST practitioners or goods and service tax practitioners can be appointed as authorized representatives. Moving on to next situation or scenario, Hema Lubricants Limited filed an appeal before the appellate tribunal against the order of the appellate authority, wherein the issue was revolving around the place of supply. The tribunal decided the issue against the company and in favor of the department, against the company and in favor of the department. The company is of the firm opinion that its view is correct, and hence there is a need to take issue to an appellate forum higher than the appellate tribunal. As the company secretary dealing with the indirect tax matter advised the company about filing of an appeal before the appropriate forum. So now we need to give what is the next redressal mechanism that is available. Appellate authority is over. Now from appellate authority, it is also before the appellate tribunal. Appellate tribunal is also over. What happens after appellate tribunal? It needs to go to High Court. Even if High Court is not possible, it will go to Supreme Court. Where the supplier or the department is not satisfied with the order passed by the state bench or area bench of the appellate tribunal, appeal can be filed before the High Court. If the High Court is satisfied that such an appeal involves a substantial question of law. Before High Court, always it is question of law only. Question of fact cannot be admitted before the High Court or Supreme Court, both in income tax and direct tax. Nevertheless, appeal against orders passed by the national bench or regional bench of the tribunal can be filed only before the Supreme Court and not before the High Court, if it is a national bench or a regional bench. As per section 109(5) of the Act, only national bench or regional bench of the tribunal can decide appeals where one of the issues involves relate to the place of supply. Since the issue involved in the given case relates to place of supply, the appeal in the case would have been decided by national bench or regional bench of the tribunal. Consequently, in the case of merits of the case favors Hema Lubricants, it may choose to file appeal before the Supreme Court because it is a case of place of supply and it needs to go to Supreme Court and it cannot go to High Court. Whether proceedings for rectification, appeal, and revision of any order passed by an officer appointed under CGST Act 2017 can lie before an officer appointed under SGST Act. So there is 2 laws. One is SGST, state government, and the CGST, central government. Any order passed by central government, can it be rectified by SGST officer? That is the question. As per section 6, subsection 3 of the CGST Act 2017, any proceedings for rectification, appeal, and revision wherever applicable of an order passed by an officer appointed under the CGST Act shall not lie before an officer appointed under CGST Act or UTGST Act. Now, the officer appointed by central government is final, or that order cannot be reviewed or revised or rectified by an officer appointed by UTGST or SGST. Bhargav Pesticides Limited. So can one of you read this question for me? Let me also listen out.
Bargo Pesticides Limited, a domestic company, intends to start a business in Kolkata involving supply of certain goods, mostly meant for foreign buyers in China. There is some difficulty in the classification of goods. Can the company seek advance ruling from the authority of for advance ruling formed under GST Act 2017 in respect of the issue of classification of goods? Can the company also seek the ruling on issue involving the place of supply?
So here the question is, what what kind of issue can it go to advanced ruling authority? Section 97(2) of the CGST Act prescribes questions or matters on which advanced ruling can be sought. So what are those? Classification of any goods or service or both. So for classification matters, I can go. Applicability of a notification issued under provisions of the Act. For applicability of notification, I can go. Determination of time and value of supply of both services and goods, I can go. Admissibility of input tax credit of tax paid or deemed to have been paid, it is permissible. Determination of liability to pay on goods or service or both. Whether applicant is required to be registered, whether within respect of registration, I can go and ask. Whether a particular thing done by the applicant with respect to any goods or service or both amounts to or results in supply of goods or service or both within the meaning of that term. For these cases, I can go. Therefore, in the current case, they have given three aspects we need to understand. The company can seek advance ruling for determining the classification of goods proposed to be supplied. Determination of place of supply is not one of the specified questions matters on which advance ruling can be sought. Time of supply, value of supply can be determined. Place of supply cannot be determined by going to authority for advance ruling. Hence, the applicant cannot seek the advance ruling for determining the place of supply of goods proposed to be supplied by the applicant. Briefly discuss whether the following powers vest with the Commissioner appeals under GST Act. Whether the Commissioner appeals can they remand the case back to the adjudicating authority, or can they condone the delay in filing the appeal before him? In the first case, they cannot remand back. They don't have the powers, but they can condone the delay in filing the appeal before him. Commissioner, being the first appellate authority, does not have power to remand the case back to the adjudicating authority for fresh adjudication. The power is not given to Commissioner appeals by statute. However, power to remand has been specifically given to appellate tribunal under section 113 of the CGST Act. So appellate authority cannot remand back. Appellate tribunal can remand back to the lower authorities. Commissioner appeals, if satisfied that the appellant was prevented by sufficient cause from presenting the appeal within the specified period, allow it to be presented within a further period of 1 month under section 107, subsection 4. So up to another further extension of 1 month can be provided by the Commissioner appeals for condoning the delay in filing the appeal before him. What is the jurisdiction of national and regional benches and the state and area benches of the tribunal? We discussed just now, the place of supply matters are before the national bench, correct? So the national bench or regional bench of the appellate tribunal shall have jurisdiction to hear appeals against the orders passed by the appellate authority or the regional authority in the cases where one of the issues involved relates to the place of supply. The state bench or the area bench shall have jurisdiction to hear appeals against the orders passed by the appellate authority or the relevant or the revisional authority in the cases involving matters other than those covered where the issues involved to place of supply. Place of supply always go to national or regional benches of the appellate tribunal. The state bench, all the other cases from the appellate authority. Any order passed by appellate authority, it can take. Any order passed by appellate tribunal, it will go to national bench or regional bench. Now, in case of place of supply, it does not have state bench. It need to directly go to national bench. So this we need to remember. Hope you got the clarifications on this.
Yes, sir. Yes.
Yes, sir.
Okay, we'll quickly go to GST practitioners. Okay, we'll go to GST practitioners. We have around 7 to 8 scenarios there. We'll discuss that and then go back to other topics of inspection, search, seizure, and offenses and penalties. Or we'll finish custom laws and then come there. Okay. Now we'll finish the small topics so that you will get the comfort of having the overall view. Now we have completed 3 chapters or 3 topics out of 12. So we'll see to complete more in next 1 or 2 hours and then take up the big chapter or big topics that are available. Okay. Quickly, we'll take a small 2 to 3 minute break and then resume back. It's 3:20. I'll be resuming back exactly at 3:25. Okay. So we'll start with this chapter of GST practitioners, authorized representative, and professional opportunities at 3:25 exactly. Yes, let us continue.
Yes, sir.
So GST practitioners, authorized representative, and professional opportunities. I told the section 116, subsection 1 and 1162. We'll see how and who are authorized to do the representation. How will a person desirous of becoming GST practitioner apply, and whether a GST practitioner need to register separately under GST? Yes, a person desirous of becoming GST practitioner has to submit an application in the form GST PCT1. The application shall be scrutinized, and if found eligible, the GST practitioner certificate shall be granted in the form number GST PCT2. If the aggregate turnover of the GST practitioner crosses the prescribed threshold limit, he will need to be registered as a normal taxpayer. That is, if the aggregate turnover of the GST tax practitioner, that means he's registering as GST tax practitioner, and if his turnover is going beyond 20 lakhs or 40 lakhs, he need to register as a regular taxpayer also. How can taxpayer search for GST practitioner? There is a functionality on the dashboard of the registered person on the GST portal, wherein he can get the contact details of the GST practitioners in a state, district, and PIN code wise. So once he logs into the portal, he has a dashboard. In the dashboard, there is a place where he can search the GST tax practitioners state-wise, district-wise, and PIN code-wise. What is the concept of authorized representative in GST? I told you section 116. This just now we saw same thing. 5 points: relative, employee, advocate, chartered accountant, cost accountant, company secretary, and retired commercial tax officer, and the GST tax practitioners. So I'm not going to read that again for you. Can government officers be appointed as an authorized representative? Again, same thing. A retired officer can do it. Government officers can act as an authorized representative, can be appointed as authorized representative, provided that is a retired officer of commercial tax department of any state government or union territory or of the board. Okay, so that is the kind of comfort that we need to have. Who are the persons not qualified to act as an authorized representative? Who are the person who is not concerned to act as a authorized representative? That means who is debarred or dismissed. Okay, who is convicted under any law. Okay, let us see. As per section 116(3) of the GST Act 2017, following person shall not be qualified to act as an authorized representative. Who are those? Who has been dismissed or removed from government service. Okay, who is removed from government service, who is convicted of an offense connected with any proceeding under this act, the state, the CGST or SGST or IGST Act. Okay, and if they found any imposition of law, who is found guilty of misconduct by prescribed authority, who has been adjudged as insolvent, they will not be applicable for doing so. Okay, give me a minute. Okay, let us continue. So, person who is dismissed or removed from government of all items, or person convicted of specified offense, or insolvent persons will not be considered as authorized person. And consequence of being found guilty of any misconduct, he will not be applicable for representing on behalf of the GST taxpayer. What are the recognition to a company secretary under GST? What are the recognitions to a company secretary under GST? Company secretary to act as a GST tax practitioner. Section 48(1) of the CGST Act provides for the manner of approval of goods and service tax practitioners, their eligibility, conditions, duties, and obligations, manner of removal, and other conditions relevant to their functioning shall be such as may be prescribed. Okay, so like we saw that PCT 01, first question we saw, right, that they need to file a PCT 01, and if they are found eligible, PCT 02, they will be giving approval or certificate of GST tax practitioner. Same kind of question is given here, or same kind of answer. Yeah. A goods and service tax practitioner is eligible to undertake the following task: furnish details of outward and inward supplies, furnish monthly, quarterly, annual, or final returns, make deposit for credit into the electronic cash ledger, file a claim of refund, file an application for amendment or cancellation of registration, furnish information of generation of EVA bill, furnish details of challan in form GST ITC 04, file an application for amendment or cancellation. All these things he need to do. He is obligated. Company secretary to represent before appellate authority. Under section 116 of the CGST Act, company secretary is entitled to appear before an officer appointed under this act or appellate authority or appellate tribunal in connection with the proceedings of this act. So up to appellate tribunal, company secretary can represent any of the taxpayer on behalf of such taxpayer before the tax authorities. What are the documents required for registering as GST practitioner? So documents required for registration as GST practitioner are enrollment type, central or state application, bar council membership proof for advocates, date of enrollment, photograph in less than 100 KB, valid email ID, valid phone number, membership number and valid up to, name of the university or institute, office address proof, a digital signature, year of passing and qualification of proof. In case of company secretary or cost accountant, or in case of company chartered accountant, a certificate of practice is required. In case of advocates, council membership proof is required. What is the difference between a taxpayer and a GST practitioner? So very simple. A taxpayer is a person registered under GST Act for the purpose of filing returns, payment of tax, availing input tax credit, and other compliances. Such a person is defined as a taxable person under GST Act. He is a person who carries on business at any place in India and who is registered or required to be registered under GST Act. Any person who engages in economic activity, including trade and commerce, is treated as taxable person. On the contrary, GST practitioner is a person registered as a GST professional under GST Act. A taxpayer may authorize a GST practitioner to furnish monthly, quarterly, annual returns and information on his behalf to the government. The manner of approval of GST practitioners and the manner of removal, eligibility and qualification, roles, responsibilities and other conditions are prescribed for functioning of the GST practitioner have been prescribed in the Rule 24 and 25 of the return rules. A taxable person can add a GST practitioner to his GST portal to allow such person to make compliance under GST on his behalf. So all these are automated now. If I'm a GST practitioner and you're a GST taxpayer, you can give my ID in your account and you can tag me. Now, your details, I will be able to log in and I will be able to file the returns on your behalf. So this is called digital automation, and there is no confusion of manual record keeping. So the tax authorities will get to know for how many cases I'm acting as a GST tax practitioner and whether I'm complying appropriately all the rules and all the obligations that are envisaged for a GST tax practitioner. Are we clear on this? Any doubts on GST tax practitioner?
No, sir.
No, sir.
Okay. Now we'll quickly go to IGST, the chapter where we are discussing about what is IGST, what was the need for IGST, and how to determine place of supply or refund of IGST or international tourist and zero rated supply. Okay. What are interstate supplies under GST? First of all, we need to understand IGST is applicable on interstate transactions. CGST and SGST is applicable on the local domestic sales within the state. IGST is applicable on sales made outside the state. If a sale is made from Mumbai to Hyderabad, then it is from Maharashtra to Andhra. Okay, so Maharashtra to Andhra, so it will be considered as the interstate supply. Now, if there is a supply coming from Chennai to Delhi, then it is two different states, Delhi to Tamil Nadu. So there is something called as interstate transaction. Then IGST will be levied. What are the interstate supplies under GST? As per section 7, of the IGST Act 2017, supply of goods and or services in the course of interstate trade or commerce means any supply where the location of the supplier and the place of supply are in two different states, two different union territories, a state and a union territory. Further, import of goods and services. The first three things is simple. Two different states, two different union territories, and a state and a union territory. In all these three cases, it is different, interstate, not locally within the state or within the union territory. So fourth thing is import of goods and service. Even in case of import of goods and service, IGST is required to be paid because it is two different country. Supply where supplier is located in India and the place of supply is outside India. Okay, supplier is located in India but place of supply is outside India, then it will become IGST. Supply to or by SEZ units or developer, even in that case it will be considered as IGST. Any supply that is not an intrastate supply, that is within the state. If it is not within the state, all other things are considered as interstate supply. Shall be treated as supply of goods and services in the course of interstate trade or commerce. So this is called your IGST. What are the advantages of IGST model? You should know why the IGST model is coming to picture as one nation, one tax that is being introduced in place of service tax, VAT. The GST model was introduced. In that, IGST is playing a predominant role. The major advantages of IGST model are maintenance of uninterrupted ITC chain on interstate transactions, no upfront payment of tax or substantial blockage of funds for the interstate seller or buyer, no refund, because earlier in case of VAT and service tax and all, there was something called a C form, F form, all of that. If it is between two states, then they wanted to collect the input tax credit from that state and they need to issue a lot of documentation. All of that is avoided. No refund claim in exporting state as ITC is used up while paying the tax. Self-monitoring model ensures tax neutrality while keeping the tax regime simple. Simple accounting with no additional compliance burden on the taxpayer would facilitate in ensuring high level of compliance and thus higher collection efficiency. Model can handle business to business as well as business to consumer transaction. These are all what are the pitfalls that was there in the VAT regime or in the case of service tax regime. They are envisaging all of that and overcome that through this kind of IGST model. How will the IGST be paid? Discuss with the help of an example. Rule 88A, order of utilization of input tax credit. Very important. This order of utilization is frequently asked in alternative examination. If not the last exam, this exam, it will be most likely to be asked for. Input tax credit on account of integrated tax shall first be utilized towards payment of integrated tax. Now, input tax credit, now there is called IGST input. IGST input can be utilized against the payment of IGST output, first order of first preference. And the amount remaining, if any, may be utilized toward the payment of CGST. Next preference is CGST. So IGST versus IGST, IGST versus next is CGST. Last option will be against the SGST or Union Territory tax, as the case may be in any order. Provided that the input tax rate on account of central tax, state tax or union territory tax shall be utilized towards payment of IGST, CGST and SGST or union territory tax, as the case may be, only after the input tax rate available on account of IGST has first been utilized fully. The new order of ITC utilization, Rule 88A, is bought wide notification number 16/2019 dated March 29, 2019, made effective from 1st April 2019. ITC of IGST, first it will be adjusted against IGST output, second will be CGST output, next it will be CGST or UTGST output. If there is no CGST, then it can directly go to SGST. IGST liability will be settled off first compulsorily and then free to use IGST input in either of the payment of CGST or SGST or UTGST liability in any order. Amount of input tax credit available and output liability available under different tax sets. Let us see here. Output liability of IGST is 10,000. CGST is 3,000. SGST is 3,000. ITC available is 13,000 for IGST. CGST is 2,000 and SGST is 2,000. Total 16,000 output liability and input liability 17,000. How do you set off? See here. First, discharge of output liability on account of IGST. So out of 13,000, you are discharging 10,000 of output liability. This 13,000 you have the liability input tax credit of 13,000. First, it will offset the 10,000 liability. Next, it can offset the 3,000 CGST liability. Okay, so here you have 3,000, 10,000 first IGST is getting offset. Discharge of output liability on account of CGST. Now, CGST I can utilize 2,000 and SGST I can utilize 1,000. Balance of ITC is 0. Now you have 2,000 of CGST balance and SGST balance. SGST I've utilized only 1,000. So SGST you will have SGST you have 1,000 balance totally here. See here 10,000. This is got completely utilized. 3,000 is completely utilized, out of which 1,000 is utilized here. Out of 2,000 of CGST input credit, you have balance of 1,000. SGST, you had, what is the liability? You had 3,000 liability. So you utilized both here, 1,000 and 2,000 here. So CGST input credit is reduced to 0. You don't have anything. So it is completely utilized. And balance, you have only CGST input credit of 1,000. So this is the order of sequence. Any confusion in this? Is it clear, or you want? This is one way of option. That is, first you are giving this 3,000 is divided into SGST and SGST, SGST and CGST. In another case, it can be 1,000 here and 2,000 here. So then you will have the reverse way of understanding.
It is actually pretty clear, sir. It is good.
Yeah. So define export of goods and export of services. How are export treated under GST? The definition of export of goods in section 2 subsection 5 of IGST Act has been straightly taken from section 218 of the Customs Act 1962 and means taking goods out of India to a place outside India. Very simple. Export means it should go out of India basically. As per section 2 subsection 6 of the IGST Act, export of service means the supply of any service when the supplier of service is located in India, the recipient is located outside India, the place of supply of service is outside India, the payment for such service has been received by supplier in convertible foreign exchange, the supplier of service and the recipient of service are not merely establishments of distinct person in accordance with explanation 1 to 8. So I should have supplier in India, recipient outside India, supply of service outside India, and receipt of money in foreign exchange is the criteria to say that it is export of service. All exports are deemed as interstate supplies, and export of goods and service are treated as zero rated supplies. The export, now this is very important, you need to remember this in this manner. The exporter has the option either to export under bond or letter of undertaking without payment of tax and claim of refund of ITC, or pay IGST by utilizing ITC or in cash at the time of export and claim refund of IGST payment. So this summary we have discussed quickly. We are again re-summarizing here as to how and what is paid here. How is zero rated supply different from exempted supply? Zero rated supply is that it can be converted into taxable rate anytime. Exempted supply is kept outside the purview of taxability itself. Zero rated supply means it is under the purview of taxability, but for now it is zero. It can become 5, 12 or 18 or 22, anytime it can change the rate. But exempt means there is no, it is not coming under the purview of the taxable list itself. So let us try to understand the difference between zero rated supply and exempted supply in a tabulated manner. Meaning, exempted supply means supply of any goods or service or both which attracts nil rate of tax, or which may be only exempt from tax under section 11 of CGST Act or under section 6 of the IGST Act. Zero rated supply means export of goods or service or both, or supply of goods or service or both to SEZ developer or SEZ unit. That means it is equivalent to export where it is exempt, but it is zero rated. Okay. Tax treatment: no tax on outward exempted supplies. However, the input tax supplies used for making exempt supplies to be taxed. No tax on outward supplies. Input supplies also to be tax-free. So it cannot be utilized in both the cases. Input tax credit. Credit of input tax needs to be reversed if taken. No ITC on the exempted supply. No input tax credit in case of exempted supply. Credit of input tax may be availed for making zero-rated supply even if such supply is an exempt supply. ITC allowed on zero-rated supplies. So that is the difference. You can take the input tax credit in case of zero tax supplies, but not in case of exempt supplies. Value of supplies for apportionment of ITC. Value of exempt supplies for apportionment of ITC shall include supplies on which the recipient is liable to pay tax on the reverse charge basis, transactions in securities, sale of land, and subject to clause B of the paragraph 5. So these are all mechanism procedural. Theoretically, you need to write this, but no questions have been asked in case of proportionate reversal and all of that. Because it is very simple. If I have taken 100 rupees input credit, and if my 20% of the sales is export or exempt supply, then 20% of 100 I'm not eligible to claim the input credit. Basically, that is the proportionate supply. My total turnover is 100. Out of that, 20% is exempt turnover. That means the input credit that I've claimed, 20% of the input credit is not eligible for input tax credit because it is against the exempt supply. Value of zero-rated supply shall be added along with the taxable supplies for apportionment of ITC. Here, this will be considered for approval, included as included for the apportionment of ITC. In case of exempt supplies, it will not be considered.
So,
yeah.
So in the case where the goods were used for manufacturing both the exempted and taxable supplies, but the value is not detectable, in that case, what will we do for classification or for claiming ITC?
That is why proportionate will come into picture. If I'm using the raw materials completely for exempt goods, then entirely I'm not eligible. If I'm using for both taxable and exempt supply, then the proportionate will come. So out of the total turnover, 100%, 20% is exempt goods. Then the input credit where I have used for both taxable and exempt, 20% of this input credit will not be eligible for claiming and it needs to be reversed.
Okay. If suppose I have claimed the ITC regarding that, I have to refund.
Reverse to the extent of exempt turnover.
Okay.
Registration requirement: any person engaged exclusively in the business of supplying goods or service or both that are not liable to tax or wholly exempt from tax under section CGST or IGST shall not be liable to registration. Any person engaged exclusively in the business of supplying goods or service or both that are not liable to tax that are wholly exempt. That is, for example, I am vegetables and fruits are completely exempt. Okay, I'm doing 100 crores of turnover by selling and buying vegetables. I'm not required to register because I'm completely dealing with fruits and vegetable turnover. But let us assume I am having the other stationary items also along with fruits and vegetables. The stationary item is taxable and fruits and vegetable is not taxable. Now, since I am dealing with both taxable and exempt goods, I need to register. I cannot take an exemption. That is why it is told any person engaged exclusively in the business of exempt goods. Only then it is exempt, not required to take the registration. A person exclusively making zero-rated supply may have to register as refund of utilized ITC or integrated tax paid shall have to be claimed. So if he is not registered, then he will not be able to claim the refund. So you need to register. Tax invoice or bill of supply. A registered person supplying exempted goods or service or both shall issue instead of tax invoice a bill of supply. This also we saw in the previous discussions. Normal tax invoice shall be issued in case of zero-rated supply. So that is a tax invoice in case of zero-rated supply. Are we clear in this? So you might get questions out of this box also, what kind of invoice needs to be given, whether registration to be taken, what is the value of supplies for apportionment of ITC, whether input tax credit available. They can ask a specific question also.
Yes, sir, it is clear. It is so much clear.
Yes, sir.
Okay. Now let us quickly also cover UTGST. We'll finish UTGST and take a 5-minute break and then continue with the last 2 more chapters, that is GST compensation to states and industry sector specific analysis. Then we'll proceed to the customs, and then we'll come back to 2 more chapters, that is inspection, search and seizure, input tax credit chapter in the beginning.
Okay, sir.
Now we have
The relevance of this chapter will be finished by this year, I believe. GST compensation to states, na, sir. So, for exam perspective, it won't be that much important. For 5 years, it was from 2017. It was for 5 years now. Compensation to states.
The compensation will be for 5 years.
Correct.
So,
Yeah.
saying like
So
2023,
this year
it'll be ended.
Okay.
what we have is, you can get a question because 2022, 2017, July 2017 is the first year. Okay, from 5 years from then, it is till June 2022. And if you see the circulars that are applicable till 30th June 2022, everything is applicable.
Yes, sir.
For your exams.
Yes, sir.
So any circular or amendments made till 30th June 2022 is applicable for December 22 exams. So I feel there can be a question we cannot ignore for this attempt.
Okay.
All right, sir.
So it is
All
better,
right, sir.
it is better to not to skip, at least read through and
At
then
least
go.
to give an overview or bird's view regarding the chapter. Is
Correct.
it enough?
Yeah.
Okay. Okay, sir.
So UTGST, Union Territory goods and service tax is applicable to the Union Territories. What is introduction, determination of nature of supply, fundamental difference between SGST and UTGST, one nation, one tax, Article 370 scrapped, illustrations on levy of tax. All of this. What is, briefly discuss, they can quickly ask, briefly discuss the provisions related to the levy of UTGST. The Union Territory goods and service tax. It is levied and collected under the authority of UTGST Act 2017 passed by the Parliament. This is applicable only to Union Territories. Which are the Union Territories that we have? Andaman and Nicobar Islands, Lakshadweep Islands, Dadra and Nagar Haveli, Daman and Diu, Chandigarh and other territory. Jammu and Kashmir and Ladakh has been made Union Territories, but for the time being, Jammu and Kashmir SGST Act is applicable. Dadra and Nagar Haveli and Daman and Diu are to be merged into single Union Territory. So these are the background for which it is applicable. Section 7 of UTGST Act 2017 is a charging section which provides that Union Territory goods and service tax will be levied on all intra-state supplies of goods or service or both within a Union Territory. Now, SGST is applicable for SGST and CGST is applicable on within the state transaction. Now, UTGST is applicable within the Union Territory transaction. Intra-state supply of alcoholic liquor for human consumption is outside the purview of UTGST. Value for levy is guided by Section 15 of CGST Act 2017. Rates for UTGST are the rates as notified by the government on the recommendation of GST Council. Section 7 of UTGST Act 2017 deals only with UTGST. In case of intra-state supply, CGST shall also be levied at the rate equal to UTGST in case of intra-state supply of CGST. For example, if an intra-state supply attracts a rate of GST of 12%, then CGST will be levied at 6% and UTGST will be levied at 6%. So wherever CGST rates will come, it will be divided CGST half and UTGST half. In case of state transactions, we know that SGST half and CGST half. Similarly, CGST and SGST divided amongst themselves. Describe the impact of merger of Dadra and Nagar Haveli and Daman and Diu. Merger of two Union Territories, that is Dadra and Nagar Haveli and Daman and Diu. The big step forward to recognize the vision of minimum government and maximum governance was taken by Union Cabinet, approving the amendments or extension or repeal in abundant tax and regulations pertaining to GST, value-added tax and state excise of the two Union Territories, that is Dadra and Nagar Haveli and Daman and Diu, designating the Daman as the headquarters of the Union Territory. Now, on 3rd December 2019, the Parliament passed the Dadar and Nagar Haveli and Daman and Diu Bill 2019 for the merger of the two Union Territories and appointed the date of the said amendment was made effective from January 26, 2020. This decision was taken with an aim to strengthen administrative efficiency and fast track the development for the citizens of those two union territories. Apart from savings to the government, exchequer, and guaranteeing consistency, stability, and consistency in day-to-day working of tax authorities. Major impact on existing laws by decision of the Union Cabinet are: the Central Goods and Service Tax Act will be amended by the CGST Amendment Regulation 2020. The Union Territory Goods and Service Tax Act 2017 will be amended by the UTGST Amendment Regulation 2020. The Dadra and Nagar Haveli Value Added Tax Regulation 2005 will be amended by the Amendment Regulation 2020. So these are all amended. What are all happened in 2017, 2005, 1964? All of that had a repeal regulation of 2020. This will prompt common tax authorities better conveyance of service to citizens by lessening the duplication of work and improving administrative proficiency, help in acquiring consistency in laws with GST, VAT, and state excise, and furthermore, maintain a strategic distance from any lawful inconveniences in levy and collection of tax and duty, including recovery of arrears, and consolidate the systems of law under the same. A registered dealer based in Chandigarh makes supply to another registered dealer located in Chandigarh, valuing rupees 1,20,000. Applicable rate of GST is 12%. Calculate the amount of tax payable under GST. Now, we know that in case of UTGST, it is CGST and UTGST. 12% is divided into 6 CGST and 6 UTGST. On 1,20,000 CGST at 6% and UTGST at 6%, 7,200. Total tax liability will be 14,400 to be paid by the supplier of the product. Discuss the provisions of Section 9 of UTGST Act regarding utilization of input tax credit of various taxes available in electronic credit ledger for payment of UTGST. Now, this is again the utilization of input tax credit, like how we discussed for IGST. Let us also discuss for UTGST. As per Section 9 of the UTGST Act, the amount of input tax credit available in the electronic credit ledger of the registered person on account of integrated tax shall first be utilized towards payment of integrated tax, and amount remaining, if any, may be utilized for payment of central tax and state tax, or the case may be, and union territory tax in that order. The union territory tax shall first be utilized towards payment of UTGST, and the amount remaining, if any, may be utilized for payment of IGST. The union territory tax shall not be utilized for payment of central tax. Now, IGST can be utilized for IGST first, and then SGST or CGST, and then in the last UTGST output. But UTGST input credit can be utilized against the UTGST payment first, and then IGST. UTGST input cannot be utilized against output of SGST. So that is what is given here very clearly. Credit of IGST can be utilized first priority. First line, see the first line, the credit of IGST. This is the credit. This is the input credit, can be utilized first to IGST, next to CGST, third is SGST or UTGST. Now, credit of CGST can be utilized for CGST in first preference, second preference IGST. It does not have priority to SGST. SGST or UTGST can have priority for SGST or UTGST first and then IGST, and they don't have priority for CGST. Credit of CGST can never be used to pay off the SGST and UTGST liability. So that is clearly given there. Are we clear with this? So
Yes, sir.
Credit aspect, charging aspect, and the other Nagar Haveli, Daman and Diu, they can ask a question on that.
Yes, sir. Yes, yes.
Okay, so it is 4 o'clock now. We'll quickly take a 5 to 10 minute break and come back and start with chapter 10 and 11. And then we'll finish 12. So then we'll go back to the other chapters.
Okay, sir.
Yes, let us continue with the next topic, GST compensation to states. Now,
Yes.
we have something called as CGST and SGST. Though the transaction is happening within the state, the center is getting half of the tax. Now, but this is completely because of the state economy. If Karnataka is having good infrastructure, Karnataka business will be more. If Maharashtra is having good infrastructure, Maharashtra is having the business more. But entire amount should have been with the tax authorities of the state, but it is going towards the central authority of the state. So why is this happening? So this is, for this they said they are going to compensate. They are going to compensate by way of compensation to states. So what is that compensation? How is it going to happen? Let us see. Levy and collection of cess, returns, payments and refund, input tax, credit of cess paid, compensation cess on goods exported, establishment of GST compensation fund. All of this is going to be covered in this chapter. Why Goods and Service Tax Compensation to States Act 2017 enacted? One of the biggest challenge while introducing GST in India was that states were opposing GST because of their fear of losing revenue after introduction of GST. The fear was more pronounced in case of manufacturing or supplier states, since the GST was to accrue to the state, where the actual consumption of goods takes place as GST in destination-based tax. So this was the major reason. Now manufacture is happening in Karnataka, but this is sold to all the other states. But since it is sold to all other states, what would have happened? It would become IGST. The entire tax is going to the integrated tax and it is going to the center. So that is why they wanted to give this compensation. In order to ensure steady flow of revenues to the state by way of compensating the loss if it arises, Clause 18 of the Constitution, 101st Amendment Act 2016 specifically provided that the Parliament shall by law, on recommendation of the Goods and Service Tax Council, provide the compensation to the states for loss of revenue arising on account of implementation of GST for a period of 5 years. So that will be, the period of 5 years is from 1st July 2017 till 30th June 2022. Next question. Briefly discuss the provision relating to levy of compensation cess. What is compensation cess? Now, this is something which they're collecting in order to give the compensation to the states for the loss that they have. Compensation cess is levied. Compensation cess is levied as per Section 8, subsection 1 of the Goods and Service Tax Compensation States Act 2017. As per this section, compensation cess is levied on notified supply of goods or service or both for the purpose of providing compensation to the states for loss of revenue for 5 years or such period as may be prescribed on recommendation of Council for enactment of GST law, which may arise due to implementation of GST. Now, they have told this is for 5 years. This can now be extended also, or it can be covered in a different manner also. So we will have to wait for the further update on the committee coming forward. But till now, it is specified goods. For example, if you take any cool drinks, on all the cool drinks or the juice that you have or the aerated drinks that you have, on all the aerated drinks, there is something called as compensation cess. The compensation cess will be going to the central government in order to compensate the loss incurred by the state government during the implementation phase of the GST. Explain the following: projected growth rate, base year, projected revenue. Projected growth rate, base year, and projected revenue. Projected growth rate means Section 3 of the CGST Act 2017 provides that the projected nominal growth rate of revenue subsumed for a state during the transition period shall be 14% per annum. Shall be 14% per annum. So they are telling that that projected nominal growth rate of revenue subsumed for state during the transition period shall be 14% per annum, and the base year, that is 15-16. The base year shall be 15-16. Section 4 of the CGST Act provides that for the purpose of calculating the compensation amount payable in any financial year during the transition period, the financial year ending 31st March 2016 shall be taken as the base year. Thus, base year for this purpose is 15/16. Projected revenue. Section 6 of the CGST Act provides that the projected revenue for any year in state shall be calculated by applying the projected growth rate over the base year revenue of that state. So, for example, if the 15/16, say for example, Karnataka, if the base year revenue for 15/16 for a concerned state calculated as per section 5 is 100 rupees, then the projected revenue for financial year 18/19 shall be as follows. So projected revenue for 18/19 will be 100 into 1 plus 14, that is 14% divided by 100 to the power of 3 is equal to 48.15. So projected growth will be 148.15, 100 plus 48.15. What valuation is to be adopted for levying compensation cess? So how to levy compensation cess? Assessable value of an article imported into India is ₹100. Basic customs duty is 100. Ad valorem social welfare charge is 10%. Integrated tax rate is 18%, and compensation cess is 15%. Compute the value for compensation cess and compensation and the amount of compensation cess. The value, how do we compute? We have 100 rupees. Let us assume the value of the goods for the purpose of levying compensation cess shall be assessable value plus customs duty levied under the Act. So customs duty is 10%, that is 10 rupees. 100 plus 10 is 110. Social welfare charge is 10% on the basic customs duty. So 10% on 10% is 1 rupee. Value of integrated tax will become, value for integrated tax will become 100 plus 10 plus 1, 111. Integrated tax at 18% on 111 will be 19.98. So value for compensation cess will be 111. On that, compensation cess at 15% is 16.65. So total tax will become 111 plus 19.98 plus 16.65. Will refund of compensation cess be admissible under GST? It is provided, but how and when? Circular number 1/1/2017 compensation cess issued by board clarifies that provisions of section 16 of IGST Act 2017 relating to zero rated supply will apply mutatis mutandis for the purpose of compensation cess where applicable. This is to say that, so wherever IGST Act, however refund rules are there, it will apply in the same way. Exporter will be eligible for refund of compensation cess paid on goods exported by him on similar lines as refund of IGST under section 16(3)(b) of the IGST Act 2017. No compensation cess will be charged on goods exported by an exporter under bond. That we know, that letter of undertaking, then it is not required to pay. So this is the condition. In such cases, they cannot utilize the compensation cess paid for inputs. So where they have not paid, they will not be able to claim the input credit. The process and procedure for claim of such refund will be same as for refund of IGST. And in respect of accumulated ITC of compensation cess will be the same. Further, in case of unutilized ITC of compensation cess availed on inputs in case where the final product is not subject to levy of compensation cess. So this is something important. This kind of question can come in terms of compensation cess, how to calculate. So the value will be assessable value plus customs duty plus any social welfare charge. Is that clear here till now? Any doubts?
No, sir.
Okay, now we'll go to the different concept of industry or sector specific analysis, where we have chapter 11, which talks about when a transaction of supply of service treated as export supply under GST. Okay, now different sectors. What are these sectors? Sectors can be e-commerce sector, or it can be the export sector, or it can be airspace sector, or it can be real estate sector. We'll have to see different sector space analysis. When a transaction of supply of service treated as export of supply under GST, when a transaction can be treated as export supply under GST, that is the question. As in the earlier service tax regime, 5 conditions have been prescribed for service to be treated as export in GST. We also discussed in export, it has to be the supplier of the service should be situated in India, the recipient of the service should be situated outside India, the place of supply should be outside India, and the money should have been realized in convertible exchange foreign currency. And this is the 4 or 5 conditions that we wanted to discuss. And this is the same thing that is repeated here again, where it is told that the 5 conditions comprised in definition term export of service under section 29(6) of IGST Act are cumulative and are to be fulfilled in totality. All these 5 conditions should be fulfilled. They are under which we have already discussed. How are supplies by and to special economic zone treated in GST? So this is a special sector, special economic zone, that is SEZ. Because we have industrial zones and income tax also has certain specific deductions for SEZ. Now we'll have to see, there is no change in SEZ scheme. All imports by SEZ are exempted from any duty or tax. As per section 7, subsection 5, clause B of the IGST Act 2017, a supply of goods or service or both to or by a SEZ developer or a SEZ unit is treated as supply of goods or service or both in the course of the interstate trade or commerce. Further, as per section 16, these are considered as zero rated supply. They are considered as supply, but it is considered as zero rated supply, no taxes levied. And any import by SEZ is completely exempted as of today. What is electronic commerce and who is an e-commerce operator? Okay. Now, as per section 2, subsection 44, electronic commerce means the supply of goods or service or both, including digital products over digital or electronic network. So I am doing it on an electronic network or a digital network, then it is considered as electronic commerce through an online digital platform, that is on a website, on e-marketplace. As per section 2, subsection 45, electronic commerce operator means any person who owns, operates or manages digital or electronic facility or platform. The person who is maintaining this website is called as e-commerce operator. Discuss the following. Is it mandatory for e-commerce operator to obtain registration? Yes, it is mandatory. Whether a supplier of goods or service supplying through e-commerce operator would be entitled to threshold exemption? No, he will not be entitled. Whether TCS is required to be collected by e-commerce operator on supply of services by unregistered supplier through their portal? Yes, we need to review that. So as per section 24(x), 2410 of the CGST Act, every electronic commerce operator has to obtain compulsory registration irrespective of the value of supply made by him. The benefit of threshold exemption is not available to e-commerce operators. Okay. So now in case of person who is transacting through e-commerce operator, let us see. As per section 24, clause 9 of the CGST Act, every person supplying goods through e-commerce operator shall mandatorily required to register irrespective of the value of supply made by him, because otherwise it cannot be tracked. However, a person supplying service other than supplier of service through an e-commerce platform is exempted from obtaining compulsory registration provided their aggregate turnover does not exceed 20 lakhs. In case of special category states, it is 10 lakhs. As per section 24(9), every person supplying goods or service to an e-commerce operator is mandatorily required to register. However, by notification 15th November 2017, a person supplying services other than supplier not required. Same kind of explanation, because both of the things are required, whether he is required to register or not. Briefly discuss TCS provisions, when a TCS provision is applicable and required to be paid. This provision is applicable only for e-commerce operators under section 52 of the CGST or SGST Act. Every e-commerce operator, not being an agent, needs to withhold an amount calculated at the rate of 1% of the net value of taxable supplies made through it, that is e-commerce website, where the consideration with respect to such a supply is to be collected by the operator. Such withheld amount is to be deposited by such e-commerce operator to the appropriate GST account by 10th of the next month. The amount deposited as TCS will be reflected in the electronic cash ledger of the supplier. The net value of taxable supplies means the aggregate value of taxable supplies of the goods or service or both, other than the services on which entire tax is payable by the e-commerce operator, made during by the month by the registered supplier through such operator, reduced by the aggregate value of taxable supplies returned to such supplier during the said month. Now, rate of TCS is 0.5% CGST and 0.5% of SGST, and the same is 1% under IGST Act. So this will be collected by the e-commerce operator and deposited to the credit of the electronic cash ledger of the e-commerce supplier. Any questions still here? Can we proceed further?
And above question number 4, B part, can you please explain?
No. E-commerce operator, is it required mandatory to obtain registration? Yes. A supplier who is supplying through e-commerce operator, whether he is also required mandatorily to, is there any threshold limit? In regular case, it is 20 lakhs threshold limit is applicable. But if a supplier is supplying goods through e-commerce website, then it says without any threshold limit, from the first rupee he is required to obtain registration. So that threshold limit is not available. That is what we try to understand.
Okay.
So let us now quickly run through customs. I want to know which question of customs is critical for you to understand, so that accordingly we can discuss.
Sir,
Yes.
sir, can we do the sums and customs instead of the theory?
Yeah, we can do that. No problem.
Like if you can give us an overview of the customs, we can start doing the sums.
No issues. We'll do that.
Duty drawbacks.
Yeah.
You can skip the theoretical part because we can cover that. It is easier to understand for customs.
No issues. So I'll do one thing. I'll quickly share the Excel part and give you the questions, and then we'll start solving there. Give me a minute. Let me fetch some problems for you. Yeah, here we have the question.
Yes, sir.
PQR and importer furnish the undermentioned data relating to a machinery imported in December 2020. Assessable value of the imported machinery is $40,000. Date of bill of entry is 8th December 2019. Basic customs duty on this date is 15%, and exchange rate notified by CBIC is $1 is equal to 74. Rate notified by Reserve Bank of India is $1 is equal to 74.5. Date of entry inwards is 6th December 2019. Basic customs duty on this date is 18%. And exchange rate notified by CBIC is $1 is equal to 70, and rate notified by RBI is 70.5. Social welfare surcharge is 10%, integrated tax is 12%. You are required to calculate the total customs duty payable, including the IGST. If required, round off your answers to the nearest rupee. Ignore IGST compensation cess. So this is your question. Okay. So you want me to solve, or you will have the bandwidth to try for 2 minutes or 3 minutes, and then can we solve together?
can you solve one question? We'll solve from the next few questions.
Give me a minute. Yeah, so let us start doing this quickly. So start writing down the answer as under computation of customs duty and integrated taxes payable by PQR. So let us do here in this manner. Computation of customs duty payable and integrated tax payable by PQR. So first thing, we need to calculate assessable value. Assessable value. Now, assessable value, how do I calculate? I know 40,000 US dollars, but which exchange rate I need to take and which date I need to take. Okay. Now, rate of exchange as notified by CBIC is important for all customs duty. RBI is irrelevant for me, so you can ignore RBI rate. And at the date of filing, bill of entry would be the applicable rate. Your bill of entry is filed on 8th December. Bill of entry is filed on 8th December, date of bill of entry. So I will take 40,000 into 74 as the exchange rate. So assessable value will be 40,000 into 74. So 29,60,000 will be the assessable value. I will add customs duty at 15%. On that date, it was 15%. So I need to take that date entry only, not 18%. So I will take 15% customs duty, add social welfare. Social welfare will be added on customs duty 10% into 10%. That will be 44,400. Then this will become total value. This will become total value.
Sir, only when nothing is given, we should take BCD as 10%, no, sir?
Yes, usually they will give. There is nothing called as they don't give. Usually they give. Total value for IGST. will become 34,48,400. For this, we need to do IGST. IGST rate is clearly given 12%, no confusion. On this, it will be 12%. So now, total customs duty and IGST payable is all the amounts. Customs duty of 4,44,000 plus 44 plus this one, 9,02,208. So these are the notes that you need to remember and keep in mind. This side. So quickly, let me know once you are comfortable, then we'll go to the next question.
The sum is clear, sir.
Okay.
Yes, sir.
Sir, if GST compensation cess is given, we have to add that also on IGST and then calculate.
Correct.
the total.
Exactly. So here in this question, they've given ignore compensation cess.
So unless they ask us to ignore, we have to take the compensation cess,
Yes.
even they give or not.
Yes, correct.
Okay. Understood, sir.
Here is the next question. Jitendra, an Indian resident aged 45 years, returned to India on 18th December 2020 after visiting Australia for 7 days. He brought the following goods with him: mobile phone, 18,000, 2 laptops, computer worth 40,000 each, a wine of 2 liters, which is 16,000, digital camera, 62,000, personal effects, clothes, 35,000, travel souvenirs, 12,000. Compute the amount of customs duty payable by Jitendra. Can you give it a try?
Yes, sir.
Yes. What is the answer? Have you got the answer? Computation of customs duty payable by Jitendra. Mobile phone. Mobile phone is required, chargeable, 18,000, no exemption. Laptops, 2 laptops, each 40,000. So here there is an exemption up to
One is
laptop.
exempted.
One laptop can be carried on. Okay, so the other 40,000 will be taxable. Wine of 2 liters is completely taxable, but subject to general allowance. There is one general allowance also. Wine, 2 liters, 16,000. Digital camera, 62,000. One digital camera, 62,000. Then comes personal effects. Whatever I bring for personal effects is not taxable. Nil and exempt. Travel souvenir, that is also not taxable. So what is the total taxable for customs? Total taxable value for customs. This is the total taxable value for customs of 1,36,000. Okay, less general baggage allowance. Baggage allowance, whatever I get 50,000 worth. I can get the baggage allowance. This is general baggage allowance. So final taxable value is 86,000. Now for baggage, customs duty is, you need to remember this, baggage customs duty is 35%. So on this 86,000, I need to pay 35% plus social welfare charges, that is 10% on this 30,100. So total tax, total customs payable is equal to 30,100 plus 3,100, 33,110. Is that clear?
Yes, sir.
Yes, sir.
Sir, the general allowance is allowed irrespective of the items given, sir.
Correct. Generally, I can carry up to 50,000, whatever I want. So no
So
customs.
whatever are chargeable to compute while computing customs duty on all those items, we can take that 50,000.
Correct. Just quickly take down whatever notes you want to quickly make note of.
Sure, understood, sir.
Yes, sir.
Okay, I'm giving you another similar examination question. What we solved the first one, similar to that, I need for you to solve this. MT Limited imported an automated machine by ship from USA in January 2021. The details in this regard are as under. Cost of the machine at the factory of the exporter is USD 10,000. Transport charge from factory of exporter to the port of shipment is USD 400. Handling charges paid for loading the machine in ship is USD 40. Freight charges from exporting country to India is 2,500. Buying commission paid by the importer is USD 100. Light trade charges paid by the importer at port of importation is rupees 8,000. Freight incurred from port of entry to inland container depot is 32,000. Ship demurrage charges paid at port of importation is 9,000. Date of bill of entry is 10th January. So on that date, we have customs rate and the exchange rate. Date of inward is 15th January. On that date, we have the exchange rate and the customs rate. Integrated tax is 18%. Ignore GST compensation says compute the total customs duty and integrated tax payable under customs law on imported machinery. Quickly, can you solve?
So we should take 75 rupees as the exchange rate and 10% as the percentage, sir.
Why 10%?
Because the later of the following date of entry inwards and date of bill of entry, whichever is later, you should take no.
Correct. So that reasoning is important.
Okay.
Yeah.
FOB is 10440.
Yes.
So I have a doubt here. The buying commission paid by the importer, we should not take that.
Yes.
Usually the commission paid by the taker, paid by the.
Not required. Not required.
Okay. Okay. Sir.
Yeah.
So if suppose the buying commission paid by the exporter, will that be taken into account?
No, irrespective of whosoever is paying, it will not be there. Though it is paid by importer, it is the cost for the importer only. If it is
Yes.
paid by exporter, it is not at all cost for importer.
Okay, sir.
Assessable value is 30,057.45 US dollars. Later we'll.
You are going wrong. You need to convert into FOB value into INR and then start adding everything. Hope all of you have got the same answer.
Sir, can we round up or should we take everything with the points?
When we
Can we round it off or should we take everything with the point?
you can take it with everything with the point, no problem.
Okay.
Like it will automatically get rounded off like 9,96, so 99,631. You can take it as 31, and social welfare will be 9,963.
Okay. Like when they check the answer key, are they very particular about?
No, no, no.
Okay.
Can we go to next one? You're still writing down?
No, sir, done.
Yes, sir.
So CBZ Limited, manufacturer of garments, during the month of March 2020 had exported the following brands or products to the customer in Germany. FOB value of goods exported amount is 4,30,000, 6 lakh and 3 lakh. Market price of goods exported is 3,50,000, 7 lakh and 3,50,000. Rate of duty drawback is 30% of FOB, 3.5% of FOB and 1.5% of FOB. You are required to work out the amount of duty drawback as applicable as per Section 75 of the Customs Act 1962 in each of the aforesaid cases of export goods, keeping in consideration the following information. That is, import value of product B is rupees 8 lakh and product C is manufactured out of the duty-free imports. So A 4,30,000 into 30%. So this is my duty drawback, but I also need to check FOB duty drawback. But I also need to check it should be less than 1/3 of the market value. Market value is 3,50,000. So 1/3 of market value is 1,16,616, 1/3. So my duty drawback entitlement, duty drawback is only 1,16,000 because it cannot be more than 1,16,000. This is in case of product A. Product B, what they say, imported value of product B is 8 lakhs. So 8 lakhs they have purchased and they've exported only 6 lakhs. Since the value is lesser as per the rules of Section 75 of the Customs Act, no duty drawback shall be allowed. In case the export value of goods is less than the value of imported goods used in the manufacture or process of the goods. So in this case, they've imported for 8 lakhs and they've sold only 6 lakhs. So there is no duty drawback eligibility. The third one, again, the manufactured is out of the duty-free imports. So since it is manufactured out of duty-free imports for export, there is no duty drawback. So product B and product C, it is nil. Only product A, it is restricted to 1/3 of the product value. So you should not calculate for product B and product C. And you should give the reason as to why it is not entitled. That clear?
Yes, sir.
Sir, could you repeat the reason for product B, sir? I don't understand.
The value of export should be more than the value of import. Then only they'll be eligible for duty drawback as per Section 75 of the Customs Act. In this case, the value of import is 8 lakhs of product B, but export is 6 lakhs. That means they have only purchased and sold. They have not done any manufacture. There is no value addition to give the duty drawback.
Yes, sir. Understood, sir. Thank you, sir.
So next question. Compute the total customs duties and integrated tax payable based on the following information. FOB value of solar cells is 1,01,000 US. Rate from exporting country is $250. Insurance is 10. Buying commission is 50. Date of filing bill of entry on 20th Jan is BCD 5%. Safeguard duty is 70%. Exchange rate notified by RBI is 70.05 and the CBIC is 70 on the date of presentation of bill of entry. So can you quickly solve? Simple one.
Sir, what is the CIF value?
Yeah, value you need to do FOB plus freight plus insurance, you get CIF value.
Sir, I'm getting 88,200, sir. Is it correct?
88,200.
Yes. Sir.
Okay. Would be correct.
The final value is 93,051.
Not sure. Let me check.
Okay.
Quickly check where you're going wrong.
Sir, I forgot that freight air should be less.
No, it is assumed. Even if you have taken 250, it is fine. You should write a note telling that it is other than year.
Generally, which should we consider, sir, that it is fair or?
If no information is given, then you need to write a note, basically.
Okay, sir.
You
So
can
now
take the
should
full.
we,
You can take the full amount and then tell that it is assume that it is not through year.
okay, sir.
All of you are getting the correct answer now.
Yes, sir.
Where did you go wrong?
That fright, I took the full
Fright.
value.
Yes, sir.
Is that fine? Can we proceed to next?
Sir, 1 minute. I could copy this sum.
Okay, you can. I'll give 2 more minutes time. You can quickly finish writing it now.
Sir, how to assume IGST as 5%, sir? Ma'am, you had taken freight value as 250. What answer did you get at that time?
You need to just substitute. You can do 250 and you can do not an issue. Everything will change. Your customs duty will increase.
Sir, I got an answer with that. I just wanted to check if it was correct. I think someone else also did it using.
If you have done the calculations correct, it is fine, not an issue.
Sir, they have given that IGST, we are supposed to assume it as 5%. Like, how for all the things we should assume it as 5%, or is there any specific rates which should be taken
You
into
can assume 12% also. You can assume whatever rate, not an issue.
18% also?
Yeah.
Yes, sir, we can move to the next.
Yes, sir, we can move.
You're able to get the answer for this?
No, sir, I'm not very conversant with warehouse provision.
Simple, right? It is just $2 lakh you need to convert, and then customs duty and social welfare, and you get the customs duty payable. Everything is given there, right?
Sir, interest should also be paid for not taking out the warehouse goods on time.
No, no. Not required. What about others? Are you able to get the solution?
No, sir. Finding difficulty.
Even I couldn't.
This is the logic, or this is the time. If the information is given in tabular format, you will start solving somehow. If it is given in paragraph,
We will get phobia.
if you see the solution, you will feel only so much or what. It is very simple. You need to just convert $2 lakh into the conversion rate and then convert in basic customs duty, because that is the applicable rate. They have given different rates from 2019. You will have to take the 10% respectively. Okay. Now the date here, which you need to take, is the date of till the goods were not cleared till 28th February. So from 28th February, it was 10%. So you need to take 10%. Only that is the confusing part here. Otherwise, everything is simple.
Understood, sir.
Understood, sir.
Yes, sir.
Yeah. Let me try to give one more problem. Yes, this is a simple one. We have solved many problems similar to this now. Simple? Easy? I think.
Yeah. Yes, sir, we are doing.
Okay.
Accessible value is 26,684.
Yes, that is correct. What about others? Are you getting the same thing?
1 minute, sir.
Still doing, sir.
You will not get more time. You will have to speed it up.
Two 6,034. I'm getting
26684. I think you've forgotten to add the insurance 1.125. If insurance cost is not there, you need to mandatorily add 1.125% on the FOB value.
yes, sir. Insurance component, 5%. Two 6,684.
Yeah.
Sir, is IGST given in this question, sir?
No, not a given.
Yes, sir. I'm having
It's here in the last line. Rate of IGST is 12%.
Okay. Yes, sir. Sir, at what stage should we convert the dollars into rupees, sir?
Any stage, FOB value or CAF value, anything is fine.
Okay, sir. Because I was converting everything and I think it was taking.
See, in the previous problem, till FOB they had given in US dollars, and later on everything they had given in Indian rupees. So it is better to convert at FOB.
Okay, because here they've given everything in dollars.
You can convert at the last also.
Okay.
If you convert at FOB value, then each value further, like freight, light rate charge, demurrage charge, everything you need to convert separately.
Yes, sir. I did that. I think that's taking a lot of time.
Ah. You all are writing under new syllabus, right?
Yes, sir.
Yes, sir.
Okay. But I heard there is one elective paper with direct tax clause also. That is not applicable for you guys?
No, sir.
I
No.
think they removed it or something, sir.
Okay. I think in the recent past, in the new syllabus, they're asking all theoretical questions in customs rather than the practical.
As far as I saw, I observed that only, sir. Most of the customs questions were simple theoretical questions, not so much practical.
Correct. In the old syllabus, this kind of problems were coming.
Yes, sir. Yes, sir.
Yes, accessible value problems are coming.
So is that sufficient? Do you want some more problems or you're comfortable now?
Sir, comfortable.
Confident, sir.
Okay. So Can you do this once? There's one small problem, but tricky one.
Sir, could you help us?
Yes, sure. 1 minute. So what is CIF value? CIF value is given as is 5,000. The exchange rate notified is 70. So I need to multiply and take INR value 3,50,000. So
Sir, we should
68.
take 60.
Yeah. Yeah, 3,40,000. Now, if I have to calculate, I need to subtract the insurance cost and I need to subtract the freight cost. Now, as per rules, we know freight should be minimum 20% on FOB and insurance should be 1.125% of on FOB. That means we can understand this is inclusive of that. Now I need to remove 21.125% of CIF. Let us assume this is inclusive of 21.125%. I will get 2,80,000. So this is 121.125%. That means this is my FOB value. Now if I do a recalculation, if I do add FOB, add freight, on this I do 20%, and then add insurance, on this I will do 1.125%. So total will become CIF value. Simple mathematics. I will get 3,40,000 back. So my answer is 2,80,702. when nothing is given about freight cost and interest cost, insurance cost, I need to assume 20% on FOB and 1.125% on FOB.
So the 28 lakh 702 FOB value, no sir.
Right.
You have to subtract 3 lakh 40,000 minus 21.125%.
Correct.
Okay.
Not minus.
Okay.
3,40,000 is equal to 121.15%.
Yes, yes.
125%. That is including of that.
Yes.
What is 21.125%? Now, if you do 3,40,000 divided by 121.25%, you get this much. But if you multiply with this, you get the insurance and freight cost. That is 59.298.
Okay, okay, sir.
Yes, sir, got the answer. Should we round it, sir?
You can round it, no problem.
Okay, sir.
Done, sir.
Done. Okay. Any specific doubts on other aspects of any of the other chapters, either in GST or income tax or customs? Specifically, you need anything to be covered?
Duty drawback. If if you have any solved ones also, you can share in the WhatsApp group. We can follow it.
Duty drawback, what
Baggage.
exactly you are looking at? I did not understand. If you ask specifically what is required, I can tell you.
Like problems in baggage and duty drawback, we will get some practical problems even, sir. What shall be the drawback amount, like that? Hello?
No. I have not seen any question coming on duty drawback. All theoretical questions only will come as to just now we saw, right, that 1/3 of the market value, and one problem we did that where we need to see the duty drawback is on FOB and percentage will be given, and we need to calculate that percentage on FOB value and cross check with the limits of 1/3 of the market value. If it is more than 1/3 of the market value, then limit your duty drawback to the 1/3 of the market value. This is what we did here. And then we told in terms of if the export value is more than the export value is less than the import value, then no duty drawback. And in case of manufacturing of the export is used using duty-free products, then again duty drawback is not available. Duty drawback is available only when you have paid tax, and then you get the duty drawback. If you are using the
Like refund.
if you're using the products which are already duty-free, then you will not get the duty drawback. Section 74 to 76 of Customs Act need to be revised, and you need to understand that. Simple
Yes.
as that.
All right.
Okay, next.
I have a small doubt, sir. Could you help us solve any one somewhere in ITC? They are under composition levy and they are converting into the normal levy, and we need to calculate the interest rate per quarter. I'm going wrong in the calculation of quarters. If there is any somewhere we are supposed to find out how many quarters are there and calculate the 5% on that. I want to do something like that.
You have the question before you?
Yes, sir.
Okay, 1 second. You are referring from which material? Let me try to open that.
Sir, from some past paper somewhere I took some.
You will have to either give the question or you will have to give me the reference of the
Sir, can
document.
I send the question on the group, sir?
Yeah,
Okay, sir.
or you can send it also. I can later on clarify it on WhatsApp also. That is not a problem.
Yes, sir, I'll do that.
Yes, anything else specifically that we can cover now?
Sir,
Yeah.
so in customs also, we have advanced ruling and settlements commission, appellate
Yes,
procedures.
all of this is
And
there.
also the foreign trade policy. Is that
Yes.
so much important to cover, or?
See, it's 10 marks. 3 to 4 marks can be practical, like this duty drawback or some customs duty payable. And they can ask you some 3 marks theory and another 4 mark theory question. So in that, you can get anything in terms of interest, in terms of what is customs duty provisions, in terms of assessment, audit, anything can be asked. You
So
can
we should have an
overall view. Correct.
We should not go deep into these
Not-
topics. We should
not-
have overall views in it.
Correct.
Oh, okay. So can we have these class notes?
Yeah, I'll send it to you.
And also the direct tax.
Yes, both I will send it.
Okay, sir.
This Excel also I'll be sending it.
Yes, sir. That will be helpful actually.
I can share it right away because we have stopped most of the Excel. Let me do customs. Share it in the chat so that you can easily right away download.
Okay, sir. And also the direct tax PPT presentation, which
that I will share the link. That is
Okay.
online on the web. I'll share you the link.
Okay. Because it will be helpful for the revision. Last time revision will be more helpful.
Correct. Sure.
So can you give us tips and tricks about writing those tax papers, or any specific we should mention any specific things? Or we
Present
should...
your answer in a very clear way. First thing.
Okay.
Don't assume that if you write more, you will get more.
Okay.
If you write less also, if it is correct, you will get the marks.
Okay, sir. We should be specific about the things we are writing.
Correct. I've shared 3 files in the chat box. You can download all those 3.
Chat box. In WhatsApp chat box, sir?
No, Zoom chat box.
I can't find anything.
Others, are you able to see it?
Yes, sir, I'm able to download. I got all the 3 folders.
Yeah, you can go to the chat box, go to that options where more you have chat box. Then you go to the chat box. You're able to type anything in the chat box?
Yeah, sir.
So scroll up and see, you will be able to get. Above that, is there nothing? You're not able to find?
No, sir. It's okay, sir. I can get it from Bhagavi.
Okay. I'm resending. Did you find this Excel file? No.
Sir, I couldn't find.
Okay.
It's okay, sir.
Sir, I'll send it to her.
Yeah, sure. Fine.
Sir, if there is any doubt before exams, can we have any contact information to post you?
Yeah, you can send me on WhatsApp and I'll look into it and I'll revert you.
Okay, sir. Can we have your number, sir?
Good number of questions have.
Hello?
Pardon me? I think somebody was asking something.
Yeah.
Number of questions have completed.
Huh?
In the last 2 days session, we have completed good number of questions, I mean to say.
Yes.
Coverage was very good. Overall, the session was good, sir.
Actually, we
Helpful,
gained
I mean
some
to say.
confidence regarding direct tax.
So that is why I spend more time on direct tax, since you all said GST is a little comfortable.
Because